Good morning. This is an open meeting of the U.S. Securities and Exchange Commission on March 6, 2024, and I want to welcome members of the public listening in through sec.gov. Today, our commission will consider two recommendations from staff, each on adopting new rules, final rules. The first will be whether to adopt new rules to mandate climate risk disclosures by public companies and in public offerings. And we'll take a short break in between these two, I should note. And then the second will be whether to adopt final rules to enhance disclosure requirements for order execution quality. This is with regard to stock trading. I look forward to discussing both of these recommendations from the staff. We're going to start with the climate risk disclosure. Today, the Commission is going to consider whether to adopt final rules to mandate climate risk disclosures by public companies, and as I said earlier, in public offerings. I'm pleased to support this adoption because it benefits investors and issuers alike. I think it would provide the investors, on the one hand, with consistent, comparable, decision-useful information, and on the other hand, issuers with clear reporting requirements. Our federal securities laws lay out a basic bargain. Investors get to decide which risks they want to take so long as companies raising money from the public make what President Franklin Roosevelt called complete and truthful disclosure. He's the one that, along with Congress, laid out the securities laws 9 decades ago. And the SEC has an important role overseeing the disclosures at the core of that basic bargain. Our agency, though, was set up to be merit neutral. Thus, the SEC has no role as to climate risk itself, but we do have a role with regard to disclosures. And over the last 90 years, we have updated from time to time the disclosure requirements underlying that basic bargain, and when necessary, provided guidance with respect to those disclosures. We did in the 1960s when we first offered guidance on disclosure related to risk factors. We did so in the 1970s regarding disclosure related to environmental risks 50 years ago. We did so in the 1980s when the agency adopted what's called management discussion and analysis, and we did in the 1990s with regard to executive stock compensation. And we did it as well in 2010 when the Commission issued guidance called the Climate Guidance about climate-related risks. So, of course, there were lively debates in each and every one of these, from the 60s to as recently as now, about these disclosure requirements. But today, when we look back, these disclosure requirements have become integral to our disclosure regime, integral to how investors make investment decisions, and it's hard to imagine investors not having access to them. They also, of course, have led to changes over time. Also, I would say, consistent with the agency's disclosure rules over these decades, today's final rules are grounded in materiality. And materiality represents a fundamental building block of the disclosure requirements under the federal securities law. You'll hear staff talk about that with regard to what we're doing today. Materiality was actually in those first laws in the 1930s, in the anti-fraud sections and other sections around what underwriters' liabilities were about. But the Supreme Court articulated the meaning of materiality in cases in the 1970s and 1980s. It is this standard of materiality that is reflected in Commission rules. It is the same materiality standard that appears in numerous disclosure rules, many of which I just talked about management discussion and analysis and others, around the registration statements and public company annual reports. It's the same materiality standard that is used throughout the final rules we're considering today. Now, a lot's changed in the last 14 years since that 2010 climate guidance. Far more investors are making investment decisions that are informed by climate risk, and far more companies are making disclosures about climate risk. In fact, One survey shows that the Russell 1000, already 90% of those issuers are publicly providing climate-related information, though it's generally in sustainability reports outside of their SEC filings. Further, of that 1,000 companies, 60% of those top companies are publicly providing information about their greenhouse gas emissions. Again, not necessarily in SEC filings, but investors ranging from individual investors to large asset managers have indicated that they are making decisions in reliance on that information. It's in this context that we have a role to play with regard to climate-related disclosures. Our vote today is on rules, not just guidance like we had in 2010, but on actual rules, and ones that require the disclosures to be filed, not just posted online. Today's rules enhance consistency, comparability, and the reliability of the disclosures. I think the final rules provide specificity of what must be disclosed, which will produce more useful information for investors. Far more useful, I think, than what they get today. Further, the final rules require that climate risk disclosures be included in companies' SEC filings. Might sound a bit technical, but these are the annual reports and also what's called registration statements. Bringing them into such filings, I think, will help make them more reliable. There are standard controls and procedures for filings, unlike for things just posted on a website. Consistent with our mission and congressional mandate, today's adopting release addresses climate risk disclosures in three important ways that Eric Girding and his team are going to review. Paul Munter, our chief accountant, as well. The first, the final rules update Regulation SK to require disclosure of material climate-related risks faced by a company, as well as any governance and processes used by the company to manage those climate-related risks. I'll let the team describe those other enhancements to Rule SK rather than my going through that as well. Second, the final rules will require larger registrants, specifically large accelerated filers and accelerated filers, to disclose what's called their direct emissions, some call it Scope 1, and the emissions associated with energy purchases, so-called Scope 2, when those emissions are material. Registrants also will be required to file attestation reports. This gives some assurance as to these metrics, these Scope 1 and Scope 2 emissions, and they'll help improve the accuracy and reliability of the metrics, as well as the key assumptions and methodologies. In the proposal, we took a layered approach. This is a proposal we put out 2 years ago. We took a layered approach to disclosure of Scope 3 greenhouse gas emissions. And while many investors commented on this, and many investors today are using Scope 3 information in their investment decision-making based upon the public feedback, we're not requiring Scope 3 emission disclosure at this time. Also, to address concerns raised by commenters, the rules will allow registrants more time to file their emissions disclosures, and they'll be able to file it in the second quarterly report that they file, so-called 10Qs, after the end of a fiscal year. And the third bucket, the third area I think that will be enhancing disclosures around requiring financial statement footnote disclosures on expenditures resulting from severe weather events. Companies already have to account for this. This is just a footnote to disaggregate some of these costs, and they'll be required to disclose the capitalized cost, expenses, and charges and loss as a result of such events. Well, as the release notes, many U.S. issuers that have overseas operations operating in other jurisdictions may have to comply with other jurisdictions' climate disclosure rules. I think it's important for the U.S. to have its own standards based on U.S. law, based on the economics of our markets, based upon what investors here are using to make investment decisions. And I think today's action is that important step for our U.S. capital markets. I think it's also important to have U.S. standards to which U.S. investors and issuers can point. These rules will enhance the disclosures that investors have been relying on to make their investment decisions. Issuers and investors will benefit from the consistency, comparability, reliability of these disclosures. I want to thank so many people, but I'm just going to highlight that the staff of the divisions, plural, of corporation finance that took a lead on this, but also the Division of Economic and Risk Analysis. You'll hear Eric Girding and Jessica Wachter, who lead those divisions with their staffs, as well as the offices of the Chief Accountant. You'll hear from Paul Munter, and the General Counsel, Megan Barbero, will be at the table ready to take questions. But there are many other people in the agency, of course, and also our 5 commissioners and their staffs working through this. And the full list will be on our website. Of course, our division of our Office of the Secretary and our technologists that help us pull these meetings together for the public. I'm going to now turn it over to Director of Division of Corporation Finance, Eric Girding. He'll introduce Elliot, who will give a little bit. He's the Senior Special Counsel to give more on it. And then they'll turn over, as I said, to our Chief Accountant, Paul Munter, and Aaron Nelson, and then over to Jessica Wachter. So take it away, Eric, Elliot, Paul, Aaron, and Jessica.
Thank you, Chair Gensler and Commissioners. Today, we are recommending that the Commission adopt new rules to enhance and standardize certain climate-related disclosures for investors in registration statements and public company annual reports, including information about climate-related risks that have or are reasonably likely to materially impact a company's business strategy, results of operation, or financial condition, the governance and management of such risks, and the financial statement effects of severe weather events and other natural conditions. Climate-related risks, their impacts, and a company's responses to those risks can significantly affect the company's financial performance and position, and therefore the price of a company's securities. Accordingly, many investors currently seek information to assess how climate-related risks affect a company's business and financial condition. Investors also seek climate-related information to assess a company's management and board oversight of climate-related risks, so as to inform their investment and voting decisions. Although many companies currently are providing some climate-related disclosures, this information is inconsistent and often difficult for investors to find and compare across companies. As a result, investors have expressed the need for more detailed, reliable, and comparable disclosures regarding climate-related risks. The recommended rules are intended to address those investor needs and, placed alongside disclosures regarding other risks that companies face, assist investors in making investment and voting decisions with respect to the securities in their portfolios. We make these recommendations after thoughtful deliberation and analysis by the staff, including the careful consideration of the over 16,000 comment letters, including more than 4,500 unique letters that the Commission received on the March 2022 proposed rules. Accordingly, these recommendations reflect our efforts to respond to these comment letters. Our recommendations strike the appropriate balance between investor demand for more consistent, comparable, and reliable climate-related disclosures on the one hand, and the concerns expressed by many companies and commenters about the potential costs of the proposed rules on the other hand. The recommended rules also are the result of the hard work and dedication of many Commission staffers, as the Chair already indicated. I would like to acknowledge the incredible staff members who have been involved in the rulemaking and extend my thanks for all those who have done to get the recommendations before you today. Please excuse me while I read their names. From the Office of the Chief Accountant, Paul Munter, Shaz Niazi, Aaron Nelson, Megan Van Orden, Jonathan Wiggins, Anita Gout, Gaurav Hiranandani, Mamta Soni, Vasilios Karapanos, Shana Wolfson, Jean Riggs. From the Division of Economic and Risk Analysis, Jessica Wachter, Roque Young, Min Young Pyo, Aaron Smith, Rebecca Orban, Mikhail Pebsner, Sam Croffey, Misaka Varusa Wikarana, Julio Girardi, Charles Woodworth, Louise Cianto Mansour, Farham Hamidi, Julie Marlowe, Jim Yu, Anthony Santoro, Moshe Zeffler, Ryan Brady, Mengchen Zhao, Asaf Bernstein, Philip Sporer, Evan Avila, and Sam Daniels, and Michael Davis. From the Office of the General Counsel, Megan Barbaro, Bryant Morris, Layla Baum, Evan Jacobson, Michael Killoy, Peggy Kim, Eduardo Alaman, Hillary Holman, Tracy Harden, Daniel Staroselsky, John Rady, and Samuel Goldstein. From the Office of International Affairs, Y.J. Fisher, Kathleen Hutchinson, Morgan McDonald, Eileen Radford, and Emily Albertson. From the Division of Investment Management, Brian Johnson, Zina Abdul Rahman, and Amy Miller. From the Division of Enforcement, Diana Kani, Monique Winkler, and Ryan Wolf. From the Edgar Business Office, Rosemary Filou, Rita Finch, and Ligon Pereira. And finally, from our division, the Division of Corporation Finance, Melissa Guru, Luna Bloom, Elliot Staffen, Kristen Baldwin, Valian Afshar, Almaze Samer, Dennis Hermreck, Nolan McWilliams, Grace Baer, Lindsay McCord, Ethan Horowitz, Robert Eric, E.G. Batang, Adam Turk, Ted Yu, Liz Walsh, Duck Gang, Brad Skinner, Mike Redick, Kat Bagley, Cheryl Brown, Jeb Byrne, Nabil Kima, Jason Weidberg, John Fieldson, Michael Coco, Angie Kim, Charlie Gibbs Tabler, and Chris Windsor. I will now turn it over to Elliot Staffen to present more detailed information about the final rules disclosure requirements under Regulation SK. Elliot?
Thank you, Director Girding, Chair Gensler, and Commissioners. The Division of Corporation Finance is recommending today that the Commission adopt final rules to enhance and standardize climate-related disclosures for investors. The final rules will require registrants to include certain climate-related information in their registration statements and annual reports. I will be discussing the new disclosure requirements under Regulation SK, and our colleagues in the Office of the Chief Accountant will later present the amendments to Regulation SX to require certain financial statement disclosures related to severe weather events and other natural conditions. They will also discuss the greenhouse gas emissions attestation provisions of the final rules. The final rules will create a new subpart of Regulation SK, Subpart 1500, which will require a registrant to disclose information in its registration statements and annual reports about how any climate-related risks identified by the registrant have had or are reasonably have a material impact on the registrant, including on its strategy, results of operations, or financial condition over the short and long term. Any oversight and governance of climate-related risks by the registrant's board and management. Any processes the registrant has for identifying, assessing, and managing material climate-related risks, and if the registrant is managing those risks, whether and how any such processes are integrated into the registrant's overall risk management system or processes. If, as part of its strategy, a registrant has undertaken activities to mitigate or adapt to a material climate-related risk, a quantitative and qualitative description of material expenditures incurred and material impacts on financial estimates and assumptions that in management's assessment directly result from such mitigation or adaptation activities. If a registrant has adopted a transition plan to manage a material transition risk, a description of the transition plan, and updated disclosure in following years describing the actions taken during the year under the plan, including how such actions have impacted the registrant's business, results of operations, and financial condition. This disclosure must similarly include quantitative and qualitative disclosure of any material expenditures incurred and material impacts on financial estimates and assumptions as a direct result of the transition plan. In addition, Subpart 1500 will require a registrant to disclose if a registrant uses scenario analysis and in doing so determines that a climate-related risk is reasonably likely to have a material impact on its business, results of operations, or financial condition, certain disclosures regarding such use of scenario analysis. If a registrant's use of an internal carbon price is material to how it manages a material climate-related risk, certain disclosures about the internal carbon price. If a registrant has set a climate-related target or goal that has materially affected or is reasonably likely to materially affect the registrant's business, results of operations, or financial condition, certain disclosures about such target or goal, including material expenditures and material impacts on financial estimates and assumptions as a direct result of the target or goal, or actions taken to make progress toward meeting such target or goal. If carbon offsets or renewable energy certificates, known as RECs, have been used as a material component of the registrant's plan to achieve climate-related targets or goals, certain information about such carbon offsets or RECs. The final rules include several changes from the proposed rules and are intended to meet the needs of investors while providing registrants certain accommodations to address compliance costs. These changes include adopting a less prescriptive approach to certain of the final rules, including, for example, the climate-related risk disclosure, board oversight disclosure, and risk management disclosure requirements, qualifying the requirements to provide certain climate-related disclosures based on materiality, including, for example, disclosures regarding impacts of climate-related risks, use of scenario analysis, and maintained internal carbon price, eliminating the proposed requirement to describe board members' climate expertise, requiring the disclosure of Scope 1 and Scope 2 emissions for large accelerated filers and certain accelerated filers when those emissions are material rather than for all registrants, exempting smaller reporting companies and emerging growth companies from the Scope 1 and Scope 2 emissions disclosure requirement, not finalizing the proposed requirement to provide Scope 3 emissions disclosure by any registrant, which the proposal would have required in certain circumstances, requiring disclosure of material expenditures directly related to climate-related activities as part of a registrant's strategy, transition plan, and or targets and goals disclosure requirements under the Reg SK rules rather than under the Reg SX rules, extending the Private Securities Litigation Reform Act safe harbors to certain forward-looking statements, and of course excluding historic facts pertaining to a registrant's transition plan, scenario analysis, internal carbon pricing, and targets and goals. Eliminating the proposal to require a private company that is a party to a business combination transaction registered on Form S4 or F4 to provide the Subpart 1500 disclosures as well as the Reg SK disclosures. Eliminating the proposed requirement to disclose any material change to the climate-related disclosures, which would have been included in a Form 10Q or a Form 6K for a registrant that is a foreign private issuer, and extending certain phase-in periods. The final rules allow a registrant to provide the required disclosure of its greenhouse gas emissions for its most recently completed fiscal year in its Form 10Q for the second fiscal quarter in the fiscal year immediately following the year to which the greenhouse gas emissions disclosure relates, or in an amendment to its annual report due at the same time as the second quarter Form 10Q. To provide comparable treatment for foreign private issuers, the final rules provide that the greenhouse gas emissions metrics required to be disclosed may be disclosed in an amendment to their annual report on Form 20F, which shall be due no later than 225 days after the end of the fiscal year to which the greenhouse gas emissions metrics disclosure relates. This corresponds approximately to the second quarter Form 10Q filing deadline. We recommend adopting this accommodation to address concerns by commenters that it would be difficult to provide greenhouse gas emissions disclosure by the due date of its Form 10Q, 10K, or Form 20F annual report. The final rules will be phased in for all registrants, with the compliance date dependent upon the registrant's filer status and on the content of the disclosure. Thank you, and I'll now turn things over to Paul Munter, the Commission's Chief Accountant.
Thank you, Elliot. Good morning, Chair Gensler. Good morning, Commissioners. I will discuss two specific aspects of the final rules that we are recommending today. The first relates to certain disclosures of financial statement effects that would be required in a note to the registrant's audited financial statements, and the second relates to attestation requirements over Scopes 1 and 2 GHG emissions disclosure. First, the financial statement disclosures we are recommending today focus on severe weather events and other natural conditions as proposed. The scope of the financial statement disclosures related to such events, however, has been significantly revised to balance investors' needs for more disaggregated disclosures in the financial statements with commenter concerns about the cost of the proposed rules. As a result, the recommended final rules do not include the proposed financial impact metrics, which would have required the registrant to disclose the financial impacts from severe weather events and other natural conditions and transition activities on any relevant line item in the registrant's consolidated financial statements. Instead, the final rules we are recommending focus on disclosure of certain disaggregated costs, expenditures, charges, and losses that represent quantitative information that is derived from transactions and amounts recorded in a registrant's books and records underlying its financial statements. In response to commenters, the adopting release clarifies that the requirement to disclose disaggregated financial information about severe weather events and other natural conditions does not require an assessment of whether such events were caused by climate or are climate-related. The final rules we're recommending require the disclosure of financial estimates and assumptions that have been materially impacted by severe weather events or other natural conditions, or a registrant's disclosed targets or transition plans. In response to commenter feedback, however, this requirement applies to a narrower category of financial estimates and assumptions and a narrower category of transition activities than was proposed. It is important to note that while the final rules we're recommending establish new disclosure requirements, they do not alter or establish recognition and measurement requirements used by a registrant in preparing financial statements under their applicable financial reporting framework. Secondly, we are recommending that the Commission adopt attestation requirements over the registrant's Scope 1 and Scope 2 GHG emissions disclosure for accelerated and large accelerated filers who are required to provide these disclosures. In comparison to the proposal, the final rules will be subject to longer phase-in periods, and only large accelerated filers will eventually be required to obtain reasonable assurance after several additional years. We believe these attestation requirements will provide investors with an additional degree of confidence regarding not only the GHG emissions figures that are disclosed, but also the key assumptions, methodologies, and data sources the registrants use to arrive at those figures. I won't repeat all of the many staff who have been involved, but as Director Girding noted, this recommendation is the collaboration of a large number of staff members across the agency who have worked collaboratively and tirelessly to bring these recommendations before the Commission, and I add my thanks to that of Director Girding. I will now turn to Aaron Nelson to provide a bit more detail on these parts of the recommendations.
Thank you, Paul, Chair Gensler, and Commissioners. I will begin with our recommendation to the Commission to adopt amendments to Regulation SX, specifically to require registrants to disclose certain disaggregated financial statement effects. The final rules will require a registrant to disclose, in a note to its consolidated financial statements, 3 main categories of information. First, the capitalized costs, expenditures expense, charges and losses incurred as a result of severe weather events and other natural conditions such as hurricanes, tornadoes, flooding, drought, wildfires, extreme temperatures, and sea level rise, subject to a 1% disclosure threshold and certain de minimis thresholds. Second, the capitalized costs, expenditures expense, and losses incurred in connection with the acquisition and use of carbon offsets and RECs, if used as a material component of a registrant's plans to achieve its disclosed climate-related targets or goals. And third, the financial estimates and assumptions materially impacted by severe weather events and other natural conditions or disclosed targets or transition plans. In addition, with respect to the disclosures I just described, the final rules will require a registrant to disclose contextual information to enable investors to understand how the registrant derived the required disclosure, including requiring the disclosure of any recoveries recognized during the fiscal year as a result of the severe weather events and other natural conditions for which costs and expenditures are disclosed. The final rules include several changes to the proposed rules that are intended to meet the needs of investors and are narrower in scope than the proposed rules to address compliance costs. These changes include, among other things, eliminating the proposed requirement to disclose the financial impact metric, clarifying that a registrant is not required to determine that a severe weather event or other natural condition was in fact caused by climate before disclosure is required, including de minimis disclosure thresholds and an attribution principle for the disclosure of expenditures resulting from severe weather events and other natural conditions, and eliminating the proposed requirement to disclose expenditures related to general transition activities in the financial statements, and instead requiring the disclosure of expenditures related to one type of transition activity, carbon offsets and RECs, in the financial statements if used as a material component of a registrant's plans to achieve its disclosed targets or goals. I will now discuss the final rules related to the attestation requirement. The final rules will require accelerated filers and large accelerated filers that are required to provide Scope 1 and/or Scope 2 GHG emissions disclosure to obtain an attestation report over such disclosure. The final rules include phase-in periods. Specifically, the final rules require accelerated filers and large accelerated filers to obtain an attestation report at a limited assurance level beginning the 3rd fiscal year after the GHG emissions compliance date, and require large accelerated filers to obtain an attestation report at a reasonable assurance level beginning the 7th fiscal year after the GHG emissions compliance date. The final rules do not require accelerated filers to obtain reasonable assurance. In addition, the final rules require the GHG emission attestation provider to be independent and meet certain expertise requirements, the attestation report to be provided pursuant to standards that are publicly available at no cost or that are widely used for GHG emissions assurance and that are established by a body or group that has followed due process procedures, including the broad distribution of the framework for public comment, the disclosure of certain information by the registrant outside of the attestation report regarding the existence of oversight inspection programs to which the provider or engagement are subject, and regarding the resignation or dismissal of a former GHG emissions attestation provider and any disagreements, and the disclosure of certain information by a registrant that voluntarily obtains third-party assurance over its GHG emissions disclosure. As with the final amendments to Regulation SK, the final rules related to the attestation requirement have been modified as compared to the proposal in response to comment or feedback. These changes include longer phase-in periods before an attestation report is required, modifying the final rules to permit registrants and GHG emissions attestation providers to use standards that are widely used for GHG emissions assurance, as long as these standards were established by a body or group that has followed due process procedures, and eliminating certain minimum attestation report requirements. Thank you, and I will now turn it over to Chief Economist Wachter.
Thank you, Erin, and good morning, Chair Gensler and Commissioners. As you've heard, today the Commission is considering adopting rules to require several types of climate disclosures in annual reports and in registration statements. Among these are disclosures of climate-related risks and their impacts on the company, the governance and management of such risks, whether the company has material targets or goals, material Scope 1 and 2 emissions for certain larger companies, and the impact of severe weather events and other natural conditions on the company's financials. Many companies already disclose some climate-related information to investors. Nearly 40% of public companies disclose information about climate-related risks in their annual reports. Much climate-related information, however, is provided outside of annual reports in what are known as sustainability reports. One recent study showed that as many 90% of large companies currently publish sustainability reports, often adhering to one of several third-party frameworks. Many companies also publicly set targets and goals, but the lack of a common reporting framework makes all of these climate-related disclosures difficult to compare. Given this situation, we anticipate that the final rules will bring a number of benefits. The first is greater consistency, comparability, and reliability of climate-related disclosures. These improvements would help investors in making decisions. Also, more usable disclosures regarding climate risks would reduce information asymmetry, leading to better functioning markets and a lower cost of capital. Finally, by giving investors better access to information, the final rules promote more efficient pricing of securities, more effective assessment of managerial decisions, and ultimately capital formation. The final rules will entail costs for companies to prepare the required disclosures. For example, there may be costs associated with developing systems for collecting climate-related information, and for some companies, measuring emissions and obtaining assurance. These costs will be limited by the exclusion of smaller reporting companies and emerging growth companies from Scope 1 and 2 emissions reporting requirements, and by a longer phase-in period for these companies for other requirements. In addition, companies that already provide some of the required disclosures, including those subject to other jurisdictions' requirements, will face lower incremental costs. In closing, I thank our colleagues from the Division of Corporation Finance, from the Office of the Chief Accountant, the Office of International Affairs, and the Office of the General Counsel for their collaboration. And thank you today for your attention.
Thank you, Eric, Elliot, Paul, Aaron, Jessica, and all the hard work of many others. I should have mentioned Office of International Affairs earlier as well. I would note for the public, we've now received, as of this morning, I think 24,000 comments on this rule. We got a flurry of additional comments in the last 72 hours. But with that, over to Commissioner Peirce.
Thank you, Mr. Chair, and thanks to Jessica, Aaron, Elliot, Paul, Eric. You can tell that it was quite a big team that worked on this rule. The final rule is different from the proposal, but it still promises to spam investors with details about the Commission's pet topic of the day, climate. As we've heard already, the recommendation before us eliminates the Scope 3 reporting requirements, reworks the financial statement disclosures, and removes some of the other overly granular disclosures. But these changes do not alter the rule's fundamental flaw, its insistence that climate issues deserve special treatment and disproportionate space in Commission disclosures and managers' and directors' brain space. Because the Commission fails to justify that disparate treatment, I dissent. The Commission does not point to a persuasive reason to reject the existing principles-based materiality-focused approach to climate risk. While the Commission insinuates that companies focus too little on climate risks, It offers scant concrete evidence of inappropriate reserve and even highlights that 36% of annual commission filings include climate information. Our existing disclosure regime already requires companies to inform investors about material risks and trends, including those related to climate, by empowering companies to tell their unique story to investors. The Commission's 2010 climate guidance explains how climate-related issues, particularly pertaining to a company's financial condition, could be required in disclosures under the Commission's existing regime. Under current rules, companies may have to disclose, among other things, information related to the impact of legislation and regulation, international accords, indirect consequences of regulation and business trends, and physical impacts of climate change. And although the responsibility for disclosing lies with the company, the Commission's Division of Corporation Finance reviews company filings and sends comment letters to companies to ensure that they are that they're fulfilling this responsibility. Companies that do not make accurate or complete disclosures could face enforcement actions or private lawsuits. The Commission does not persuasively explain why principles-based rules, staff disclosure review, and enforcement actions are not effective in eliciting the climate disclosure that the objectively reasonable investor needs. To the contrary, the Commission has a strong view of the power of existing rules to elicit climate disclosure. For example, the Commission today, in deciding not to adopt the proposed financial statement metrics, warned that companies might have to make those disclosures anyway under existing rules. The Commission, in adopting today's climate prescriptions, dismisses the role that materiality ought to play in balancing the costs and benefits of disclosure. Information is material if there is a substantial likelihood that an objectively reasonable investor would consider the information important to an investment or voting decision. All reasonable investors value financial returns, but they may diverge on which non-economic considerations are important to them. A regime rooted in materiality helps companies inform investors without spamming them with information that is irrelevant to the company's financial picture. The rule replaces our current principles-based regime with dozens of pages of prescriptive climate-related regulations. While the Commission has decorated the final rule with materiality ribbons, the rule embraces materiality in name only. The resulting flood of climate-related disclosures will overwhelm investors, not inform them. The rule mandates specific granular disclosures. These include, to list a few, the process of how a company's board oversees and is informed of climate risk, how a company's management assesses and manages climate risk, which management positions manage climate risks, and the associated expertise, the geographic location of physical climate risk, and how climate risks affect items like a company's products or services, suppliers, climate mitigation activities, and expenditures for research and development. Protestations of materiality also trip over the absurdly low de minimis thresholds for disclosing how severe weather events and other natural conditions affect a company's financial statements. The threshold is only $100,000 for expenditures expensed as incurred and losses in the income statement, and $500,000 for capitalized costs and charges recognized on the balance sheet. By rejecting a principles-based regime grounded in materiality for climate, the Commission could trigger a hodgepodge of requirements tailored to meet the demands of a vast and ever-expanding panoply of special interests. Pro-life investor, an anti-cannabis investor, or an anti-war investor might want idiosyncratic information to assess a company's performance on those respective issues. Employees, customers, suppliers, social activists, local communities, and other interested non-investors will now line up to get the information they want to know included in disclosures for which shareholders have to pay. Even asset managers, whom the release wrongly classifies as investors, and institutional investors may be driven by something other than financial returns when they seek information. An asset manager, for example, may need data not to serve its clients, but to satisfy a climate pledge the advisor made when it voluntarily joined a climate action organization. However well-intentioned, these particularized interests do not justify forcing investors who don't share them to foot the bill. Congress did not create this agency to satisfy the wants of every investor, but to serve the interests of the objectively reasonable investor seeking a return on her capital. We lack the expertise to oversee these special interest disclosures, and only a mandate from Congress should put us in the business of facilitating the disclosure of information not clearly related to financial returns. As Commissioner Roberta Carmel concluded in 1978, when debates about the role of commission disclosure were raging as they are today, despite the legitimate concerns of ethical investors, I believe we should exercise caution in applying a non-economic standard of materiality to disclosure requirements. Wading into non-economic issues involves trade-offs that only our nation's elected representatives have the authority and expertise to make. If we lose our focus on objectively reasonable investors, special interest groups will turn to us to achieve what they cannot accomplish through normal political channels. Despite cost-saving changes from the proposed rule, the final rule will prove expensive for public companies and their shareholders who will be paying for climate disclosure spam. The Commission performs impressive math acrobatics to slash the anticipated cost of the rule by almost 90%, but even with these potentially understated estimates, the Commission still must concede that this rule will increase the typical external cost of being a public company by around 21%. The rule is particularly likely to overwhelm small public companies, many of which are already struggling under the cost of being public. At a time when few companies are choosing to go public, why would we add so substantially to the price tag? To comply with the new rule, public companies will need elaborate internal control systems and disclosure control procedures to capture and distill information related to physical and transition risks, severe weather events, severe natural conditions, and greenhouse gas emissions. They'll hire third-party climate consultants, assurance providers, internal and external counsel, and information technology professionals, face legal liability through commission actions and the inevitable flood of class actions for their mandated filed disclosures, and bear the indirect costs of lost management time, board distraction, and disruptive changes in company operations. The new financial statement disclosures could force smaller companies to overhaul their existing accounting software. Even companies that do not end up reporting material climate risks or expenditures will be forced to invest in systems to reach a determination that they do not have material items to disclose. The Commission doesn't take full account of the cost to make such a non-materiality determination. Requiring public disclosure of such extensive climate information, including on governance processes, will reduce companies' flexibility in responding to all kinds of risks, including climate risks, and deter them from engaging in substantive improvements to business processes. The rule's anticipated benefits do not outweigh the costs. Proponents of a Commission climate rule hope that it will yield more accurate, comparable, and complete climate disclosures. If we do not look at it too closely, the final rule may appear to fulfill these hopes, but a closer inspection brings us crashing back to the reality that many climate disclosures are high-priced guesses about the present and future. Measurement and reporting are not standardized within companies, let alone across companies. Attempts to treat climate data on par with financial data are strained. Despite ongoing efforts to improve climate data collection and analysis, they are still imprecise. For example, commenters highlighted the difficulty of accurately predicting potential physical climate risks and transition risks. Technical compliance with this rule will produce authoritative-looking results, but underlying them will be layers of assumptions and extrapolations. Different companies will take different approaches to resolving these uncertainties, which will undermine comparability. More bespoke disclosures, such as the current rules allow, better inform investors, and over time, companies likely would coalesce around approaches that generated reliable and comparable disclosures. Letting that process play out organically would be superior to the top-down approach that we're embracing today. The final rule attempts to shortcut this admittedly protracted market-driven process, but the result will be unreliable disclosures that mask real differences across companies. Also concerning is the possibility that the back of the envelope guesswork underlying the climate disclosures will bleed into the financial statements and other disclosures, thus undermining the effectiveness of our disclosure and financial reporting regime. As efforts to integrate financial and climate reporting proceed, the lower standards accepted by necessity for climate reporting and assurance could bring down the quality of financial reporting. While the Commission feigns agnosticism about how public companies think about climate risks, the prescriptive nature of this new climate regime will affect corporate behavior. Through an extensive set of leading disclosure items, the Commission steps into the shoes of the corporate board, nudges corporate decision-making, and distorts corporate supply chains. These new disclosure requirements are rooted in what the Commission believes should matter to investors. The Commission is forcing individual public companies to operate in a conduct-altering disclosure regime that may have no direct relevance to their situation. The Commission argues that it is well within its authority in adopting this rule, but the argument we make for our authority here has no limiting principle. The Commission could have simply required companies to disclose material climate risks that they already recognize and explain how they manage them. Such an approach would not have conveyed an expectation that companies devote vast new resources to assessing, managing, and disclosing climate risks that the Commission has identified for them. It also would have been consistent with the current required disclosure of material events and uncertainties known to management that are reasonably likely to cause reported financial information. We should be reproposing this rule, not adopting it. The final rule differs quite dramatically from the proposal, both by excluding major provisions and including new rule elements. A reproposal would have helped us better assess these changes. It also would have helped us to understand recent legal developments in California and Europe that raise complex cost and mutual recognition issues. Rather than grappling with these issues in the cost-benefit analysis, the Commission confesses to lacking the data to accurately assess them. This approach does not give fair notice to the public or allow commenters the opportunity to address anything that closely resembles today's final rule. Although I don't support the recommendation before us, I do want to acknowledge the multi-year effort underlying it. You just heard about the number of comment letters that we received. Analyzing these comment letters and the difficult issues that were discussed in them was a monumental challenge. I appreciate all the long and late hours you devoted to producing today's rule. I also appreciate the many hours you spent with me and my staff discussing the rule. Thank you to Micah Morse, Eric Girding, Luna Bloom, and other staff in the Division of Corporation Finance, Paul Munter, Shaz Niazi, Aaron Nelson, Mamta Soni, and Megan Van Orden in the Office of Chief Accountant, the Division of Economic and Risk Analysis in the Office of General Counsel, as well as others throughout the Commission who worked on this rule. I do really appreciate the time that you spent with me working through some issues, and I just want to, along those lines, discuss a few of those issues with you this morning. So maybe just starting out, the cost estimates for this rule have dramatically dropped, as I mentioned. I think now, based on our estimates, it's 14% of a company's annual SEC disclosure costs that would be attributable to climate disclosure. Do we plan to go back in several years to assess the accuracy of these estimates and then whether the benefits outweigh the costs of this rule? And if so, have we decided on what metrics we plan to use for assessing the effectiveness of the rule in achieving the objectives that we set forth?
Commissioner, I'm happy to take this question. So we are always interested in how our rules work once they are implemented. And this is something that the Divisions of Economic and Risk Analysis and Corporation Finance and the Office of the Chief Accountant are going to keep carefully in mind in the future. In terms of whether the benefits of the rule outweigh the costs, so I think the first thing we might look at is the degree to which the rule is useful for investors. And in the economic analysis, we cite a number of studies on climate risks and stock prices. And one thing one might do is repeat these studies following the implementation of the rule. So specifically, one could look at whether there is a stock price reaction to news regarding climate risks. This is a similar type of exercise to what is standard in the literature on earnings announcements, and that would be a simple way to look at whether this is something that is useful to investors. Relatedly, one could look at whether how the cost of capital relates to climate risk, and there are various methodologies to do that. which are discussed in the literature that's cited in the release. We could look at how climate risk relates to other measures of risk, such as the beta with the market, for example. Now, I agree that it would be useful to examine the level of these costs and also how the costs evolve as reporting develops. In terms of how specifically we might do that, that's something that we're happy to discuss with you.
Well, I appreciate that. I'm glad you're thinking about how to measure the success of the rule. I do think we need to go back and see what kind of costs this is imposing. One question I had, specific question about cost estimates. It seems that we omit the cost for large accelerated filers and accelerated filers to make a materiality determination on their scopes 1 and 2 emissions if those companies ultimately emit the data from their disclosures. Do you have a sense of what it could cost companies just to make that materiality assessment?
So the way that our direct cost estimates work is we start with the data that we were provided through various commenters, and there's quite a lot of comment on this subject, on making disclosure under the TCFD framework. And in addition, we also received some information on the cost of targets and goals and on the cost of GHG emissions. And so our methodology starts with the TCFD framework and then subtracts out targets and goals and emissions to have a residual, which we then attribute to, strategy, governance, and other elements. So when you say that it appears to omit the cost of making the materiality determination, it may be that the cost of making that determination or similar is in the TCFD framework, in which case actually it does not omit the cost of making the materiality determination. But as I think emerges from that description of our methodology, we actually don't have data on specifically the cost of making the materiality determination. We would anticipate that it would really vary a lot. For some companies, it would probably be de minimis.
Yeah, my guess is that for a lot of companies, it will be much more than de minimis, because I think they're going to have to set up systems to capture a lot of information and then come to some sort of materiality conclusion. So I think that's something that maybe we should think more about when we go back and look at the costs of this rule. The release promises investors more detailed, consistent, reliable, and comparable information about climate-related effects on a registrant's business and financial condition. Does any company's climate reporting today reflect that same level of consistency, reliability, and comparability that financial reporting does? And if not, how long do you think it will take for climate reporting to be as consistent, reliable, and comparable as financial reporting? That may be a question best addressed to Paul, but if someone else wants to address it, that's fine.
I can take the lead on that, Commissioner. So it's important to remember that there are two parts of the disclosure rules that we are recommending today. There are the Regulation SK disclosure rules and the Regulation SX disclosure rules. Regulation SK disclosure differs from SX in several ways. First, Regulation SX disclosures are subject to audit. These are the financial statements. And they're also subject to internal controls over financial reporting. Regulation SK rules are subject to disclosure controls and procedures. Although registrants may include some audited numbers from financial statements in Regulation SK disclosures. The new SK disclosures would bring climate-related disclosures in line with the same consistency, reliability, and comparability as existing SK disclosures. So it's important, I think, to compare SK disclosures to SK disclosures and SX disclosures to SX disclosures.
Okay, so let's talk about, Paul, let's talk about SX disclosures. Are you confident that we have the same kind of quality of reporting for climate-related matters as for financial matters?
So, Commissioner, the SX requirements, as you know, are a disaggregation of information that registrants would already be recording in their books and records. As you also know, of course, each issuer is required to keep books and records in reasonable detail so that they accurately and fairly reflect transactions and dispositions of assets of the issuer. So we're not imposing any additional accounting requirements on them, but rather just disaggregation of information for more consistent disclosure purposes. I think additionally, at least those issuers that are subject to U.S. GAAP, which of course is the vast majority of our issuer population, there's been a requirement in U.S. GAAP for literally 50 years to disclose the consequences of events or transactions that are either unusual in nature or infrequently occurring. And I think it is highly likely that many of the physical risks that might trigger disclosure under these rules would in fact fall into either of those categories. And so as a consequence of that historical experience and being more granular in terms of the when disclosures are required at a disaggregated level, I think that will lead to greater consistency in the disclosures within the financial statements.
Okay, while I have you, Paul, and what you mentioned that the rarity of these events and that companies are used to dealing with that. One thing about the final rule that puzzled me is I don't really know what the term natural condition means. So what is this? I think we're only talking about severe natural conditions. Is that right?
Correct. And one of the things the final rule does is allows registrants to make determinations in their own particular facts and circumstances as to what are severe weather events or other natural conditions. The document, of course, contains some examples, but those examples are not intended to be an exhaustive list, but simply examples. And so what registrants would do here is similar to what they would do in adopting any other new accounting standard or rule, which is they would need to develop policies specific to their own circumstances that would allow them to implement the requirements on a manner that is consistent within the confines of their operations.
But I just think that's hard to do because natural condition is such an open-ended concept. It could, I think, cover a global health pandemic. Is that your reading of it as well?
Well, Commissioner, for starters, before there would be any disclosure requirement, you'd have to have something that results in an accounting event. Because again, you're dealing with costs, expenses, losses that are actually recorded in the books and records without knowing more specifically what you have in mind in terms of a pandemic.
Well, I mean, we can think of COVID.
Accounting event would be related to that. But I think as an extension, the disclosures, financial statement disclosures are really aimed at requiring registrants to disclose when they have had a financial statement impact either to financial position or results of operations that's a consequence of physical risks.
Okay, so let's just take, if these rules had been in place when the COVID pandemic happened, I mean, a lot of companies experience costs directly related to that, right? So would those costs have been something that would have been covered by this provision?
Again, I think a company would have to develop its own policies. I think it's certainly not immediately clear to me that a pandemic is a consequence of a physical risk. But I think companies would need to develop policies that would allow them to determine whether disclosures are required given their own specific circumstances.
Okay, and so why is it less important? It sounds like you're saying unless COVID fits in the physical risk bucket, which maybe it does, and I think we probably are going to need to provide some guidance around what this term other natural condition means. But why is it that costs associated with something like COVID pandemic are less important to investors than costs associated with climate risk?
Well, Commissioner, again, it's not clear to me what you mean by costs related to a COVID pandemic. I think when you're talking about the consequence of a physical risk, it is clear to a registrant that they have had, for example, damage to property, plant, and equipment that will need to either be dismantled and disposed of, or will need to be repaired, or the like. Again, it's not clear to me from your question as to what you mean by costs attributable to a COVID pandemic.
Yeah, I think a lot of companies could spend a lot in connection with COVID. Let's go back though to scopes 1 and 2. So with respect to that, do you think that the processes, and again, whether this probably is a question for you, do you think the processes for calculating scopes 1 and 2 are on par with the processes for financial reporting?
I think that's an SK, the scopes 1 and 2 emissions reporting, Commissioner, in regulation SK, so I can take that. Again, as I stated earlier, regulation SK disclosures are not subject to audit and not subject to internal controls over financial reporting. They are subject to disclosure controls and procedures, and it's important to compare regulation SK disclosures to regulation SK disclosures.
So what kind, I mean, there will be assurance though, right?
That is correct, and Paul can talk about assurance.
Paul, is the, yeah, go ahead.
I was just going to add that, yes, there will be assurance at the limited assurance level for accelerated filers, and initially for a number of years for large accelerated filers that will be provided by an independent assurance provider. Yes, Commissioner.
Okay, and those assurance providers might or might not be audit firms. If they're not audit firms, they'll still be subject to independence requirements that sort of tack off the auditor independence requirements. Is your plan that they'll be able to come, these non-audit firms will be able to come to OCA for the same kind of consultations that audit firms would come on independence issues?
Most definitely, Commissioner, as we do for application of any accounting or assurance issues today under Commission rules, OCA stands ready to serve as a point of consultation for any assurance providers on application of these rules.
And will you be able to give those, will you be able to give no action relief or similar relief if there's a minor departure from the independence rules? How does that work?
Well, Commissioner, I don't believe that we have no action authority. We would.
What do you do with an audit firm?
We would go through our regular consultation process, Commissioner.
And how will you keep us, the commission, informed of what's happening with that? Because it seems like we're taking on the regulation of a whole new set of firms now, and I want to make sure that you're going to make sure that we, the commission, have insight into that.
We are happy to provide the commissioners with regular updates on the kinds of consultations that we're receiving.
Okay, thanks. So turning back to greenhouse gas emission disclosures, and again, this is probably something for either Eric or for the Office of General Counsel. One commenter explained it this way, that we're dealing with something new here. And I'm quoting from a commenter. The SEC's justification for the disclosure is that governments, regulators, or consumers might take action against GHG emissions that might cause a negative financial effect at the company that might be significant to a reasonable investor. The reliance on this series of possibilities is on top of the reliance on the uncertain and imprecise methods for calculating GHG emissions. The chain connecting an undependable disclosure of GHG emissions to a material financial effect on the disclosing company is long and speculative. The outward look and the speculative nature of requiring disclosure of GHG emissions make that disclosure obligation different from nearly all other mandatory SEC disclosures. Why isn't this commenter right that we're dealing with a new kind of rule here and perhaps one for which we don't have statutory authority?
Commissioner, I can take that question. So we do not believe that this is a new kind of disclosure requirement at all. The Commission has long required detailed metrics and detailed metric disclosures in Regulation SK, including detailed metric disclosures on different kinds of risk. For example, item 305, disclosures on market risk, require issuers to disclose various detailed metrics on how market risk may affect their business. I should also note that impacts of government regulation and legal proceedings are also disclosures that registrants are already very well familiar with in Regulation SK.
It's just not clear to me that Scope 1 and Scope 2 emissions necessarily pose a risk to the company. So that seems certainly like a departure from what we've done in the past.
Well, I should note, Commissioner, that Scope 1 and 2 emissions are only required for certain registrants and only if they are determined to be material by those registrants. We give two examples in the release of how Scope 1 and or Scope 2 emissions may be material. One is transition risk, whether the company or registrant faces a material transition risk. And the second relates to whether a company has targets and goals to allow an investor to track a company's progress towards targets and goals and the impacts of those targets and goals.
I mean, it seems we're putting the thumb on the scale to say we think that Scope 1 and 2 emissions are material. I don't really know how a company is supposed to make that determination. Do you foresee any unique enforcement challenges that the Scope 1 and 2 requirements pose?
I don't believe we're requiring any kind of new materiality determination. It's the same materiality standard that the Commission has long recognized. It's the materiality determination, the materiality standard that is set forth in Supreme Court case law. It's the materiality standard that is set forth in Commission rules. Again, we don't believe that these disclosures are different in kind. I will note that we don't recommend rules hoping for enforcement cases, but enforcement may bring cases on violations of these disclosure rules in the same way that they do for other disclosures. There's nothing unique about these particular disclosures.
I mean, I think the unique thing about these disclosures is that there are so many assumptions built in, so many projections about what's going to happen in elections and what's going to happen in the climate, weather, all kinds of things factor into it. What I fear will happen is that there'll be a lot of hindsight applied in the way we enforce the rules, because again, it's also up for grabs. And then once you see an event happen, you can say, well, why didn't you foresee that event? So I think that's something we're going to really have to be on guard against. This question is for Megan Barbero. Given that we take the position that we have broad authority to mandate climate disclosures, are we preempting California's recently passed disclosure law, which appears to be intended to serve as a national disclosure standard? If we're not preempting it here, do we have the authority to do that?
Commissioner, to clarify, nothing in these rules that the Commission is considering today expressly preempts any state law. The question, I think, would be one of implied preemption, and whether the Commission's climate rules have implied preemptive effect would be determined by a court in a future judicial proceeding that would come up on the specific facts and circumstances in that proceeding, which would include how the state laws were being applied and enforced.
Okay, I appreciate that. Now turning back to the rule, just to understand better how it will apply. consider, and this is, I think, for Eric. So consider a company that's building a new asset. It considers flood risk because the company in its 200-year history has experienced a flood every 10 years. Would the company's decisions relating to managing flood risk for an asset qualify either as an activity to mitigate climate risk or as a transition plan?
Commissioner, both with activities to mitigate climate risk or with the definition of transition plan, our recommendations today give registrants significant flexibility to determine whether particular activities fall within either of those two categories. The important thing about the disclosures is that companies would be required to explain their decisions in terms of how they are categorizing particular activities. And that would help investors understand the discretionary or the judgment decisions that that registrants have made.
Yeah, so I think this illustrates that comparability is going to be very difficult across different companies because they are necessarily going to take different approaches. If a company creates a low carbon product or expands its supply of a low carbon product because of increased customer demand, without considering whether the increase is due to climate change, where does that activity fall under the rules?
Commissioner, I believe you said climate change. I want to underscore one thing. That is, our disclosure requirements do not require a determination that any risk is due to climate change. The Regulation SK rules do require disclosures about climate-related risk, which, as you know, is a defined term in the final rules. Climate-related risk would include transition risk. And in the definition of transition risk, changing customer demand is one way that transition risk may manifest. Changing customer demand for a company's products and services may increase or decrease transition risk.
What if the customer demand has nothing to do with the carbon content of the product? It just has to do with what the product is. Customers like one product and not another.
Well, again, our rules do give registrants flexibility in terms of determining what may constitute a transition risk and what may not. And again, it's important, the portions of the rules that require companies to explain their methodologies and explain their decisions for categorization. And explaining the decisions allows flexibility for companies to take into account their individual facts and circumstances, but also allowing investors to determine for themselves whether they agree with those determinations and to make adequate comparisons between registrants.
Yeah, I guess in the example I just gave you, the company might not even be thinking about it in those terms, so it might not even occur to the company to provide any kind of disclosure about that because it's just figuring out which products it wants to make, which products its customers want to buy. So I think this is going to be very complicated for companies. How should a public company think about transition risk if electoral outcomes could drastically alter the risk that it faces?
So again, Commissioner, the Regulation SK rules do ask registrants to consider climate-related risks, including transition risk. One of the ways that transition risk may manifest is in changes in regulations or changes in government policies. This may require issuers to assess the likelihood of whether a regulatory or government policy change may occur. But this is no different than what issuers are already required to do under existing rules. In the description of business section of SK and in other sections of SK, registrants are already required to assess things like government regulation and material risks associated with government regulation, as well as material risks associated with legal proceedings.
Sure, I understand that, but I think that the problem is that this goes back to my question about enforcement. If a company makes a particular assessment about political outcomes in political elections that then prove to be wrong, there could be an enforcement action to say, hey, you didn't make a good prediction of where the election would come out. It becomes very difficult given the granularity of what we're requiring here.
Commissioner, I can talk about a few other features of the rules. We're not requiring prescience from registrants. Even before a company has to make a materiality determination, the rule does specify that our longstanding approach to management discussion and analysis disclosures would apply to future events here. So even before making a materiality determination, companies could assess whether a future event, including a regulatory change in the future, is reasonably likely. If a registrant concludes that a future event, including a regulatory change, is not reasonably likely, it would never have to proceed to the materiality determination.
I appreciate that. I just think the problem is that reasonably likely in the minds of one person with respect to election outcomes might be very different than they are for someone else. And there are so many assumptions and prognostications that have to be made here. I do think it's more complicated. Does climate-related risk include a situation in which there is reduced demand for electric vehicles as a result of consumer demand, political, legal, or other factors?
As I stated before, changing customer demand is one way that transition risk may manifest, and changing customer demand might increase or decrease transition risk. Changing customer demand, including reduced customer demand, might be a transition risk depending on the facts and circumstances. So
reduced customer demand could be considered to be a transition risk.
Reduced customer demand for a registrant supply goods and services could be a transition risk if registrants determine it to be while working through the definition of transition risk, including all of the features of transition risk, including reduced demand.
So would an automobile manufacturer's decision to shift away from EVs to accommodate consumer preferences be considered a transition plan?
It's hard to give a precise answer, Commissioner, because these determinations are very fact intensive. But it could, under some facts and circumstances, be a transition risk.
And so the decision to switch away from EVs could be pitched as a transition plan because you're dealing with lack of consumer demand for a product. That could be a transition plan.
Well, with transition plans, again, we give registrants flexibility to determine whether or not particular activities fit within a particular transition plan, the transition plan definition. But in order to ensure comparability, registrants have to explain their methods and assumptions, the way in which they are interpreting a transition plan for their particular facts and circumstances and the way they are running their business.
Okay, again, I think comparability across companies is going to be quite difficult. I do expect that companies will spend a substantial amount of time, money, and stress putting controls in place, whether they're disclosure controls under SK or internal controls under SX to comply with various aspects of the rule, and then obtaining assurance where necessary. Do we see similarities and differences compared to the experience that issuers had in building out their internal control systems under Sarbanes-Oxley Section 404 and getting assurance, getting the auditor attestation on that?
Commissioner, I think there are some really important differences. One is that when the requirements under Section 404B went into effect, it was a new attestation regime, and new standards had to be developed in order to provide an assurance framework for auditors to implement those requirements and report on the effectiveness of issuers' internal controls over financial reporting. With respect to attestation over GHG emissions, there are already assurance standards in place acknowledging that on both the domestic front and the international front, that there are standard-setting efforts underway to improve those requirements, but there are nevertheless assurance frameworks in place. And I think the other key difference, which we've touched on before, is unlike the application of the assurance over internal control over financial reporting that is specifically to be done by the issuer's external auditor, here for assurance over the GHG emissions, we are providing a permission for other assurance providers, either audit firms or other assurance providers, which provides for a greater pool of potential assurance providers, which should help reduce the cost of implementation.
Okay, well, the companies I've spoken to or read comment letters of seem to have a belief that they're going to spend a lot of money putting in disclosure controls or internal controls and getting the assurance, and they're not confident that this is going to be a seamless, easy process. And so it would seem to me that maybe there are some lessons that we could learn from the 404 experience, where, again, it was not a seamless, easy process. I think regulators made some mistakes. Others made mistakes as well. So can we take any lessons from that experience to make this implementation period work better?
Commissioner, I think there are always lessons to be learned from any prior experience, and I think that those are lessons that we will be very attuned to, particularly as we engage with and oversee standard setting that is going on in this area. That's certainly something we will be very mindful of.
Yeah, well, I'm glad to hear that. And Eric, I hope that you also will be very attuned to what companies are experiencing as they're trying to figure out how to deal with all the nebulous and ambiguous parts of this rule. I don't have any additional questions at the moment. Thanks.
Thank you, Commissioner Peirce. Commissioner Crenshaw.
Good morning and welcome. I want to start by thanking the hardworking staff of the Securities and Exchange Commission. Your professionalism, expertise, and dedication are surpassed by none, and it's a privilege to work with you in service of the public. You're all making your way through our regulatory agenda with poise, thoughtfulness, and creative problem solving. So thank you. I also want to thank former Acting Chair Lee for beginning this project in 2021 with a request for information, which has been instrumental in initiating this process. There has been intense media glare on our proposal and robust public dialogue. Conversations have been myriad, discourse has been at times heated, opinions have been diverse, and speculation on the substance of the rule, what is in and what's out, has reached fever pitch. But I've observed a tendency in these discussions to let the dialogue steer away from the true purpose of our proposal. We propose this rule to benefit investors who, at the end of the day, are people. That includes people who have put in a lifetime's worth of labor and who invest their savings with the promise of a better future for themselves and their families. With luck, some are able to build stability and create incremental progress toward their financial goals. Investors are at the heart of today's rulemaking, and it's critical that we give them the information they need to properly assess the risks that underline the value of their hard-earned savings. They are entitled to consistent, comparable, and reliable climate risk disclosures, and many investors have been calling for such disclosures for years. Notwithstanding that strong and consistent demand, investors continue to face costly, inconsistent, disparate, and at times unreliable data without clearly disclosed methodologies for how these data are calculated. Today's rule finally begins to change that. As you've heard from the staff, it establishes a floor for a disclosure framework that will provide investors with climate risk information, help inform investors' investment decisions, and be subject to the rigor of Commission filings. This floor, among other things, includes, first, a requirement for larger companies to disclose material Scope 1 and Scope 2 greenhouse gas emissions as a quantitative metric to gauge transition risk or a company's publicly stated target or goal. Investors have made abundantly clear that greenhouse gas emissions disclosures are necessary to understand the current and future risks to the financial condition of companies. These data may be classified by some as non-financial, but commenters emphasized that emissions disclosure is an invaluable proxy for financial risk. These disclosures serve such an important role because, among other things, they are quantitative and comparable across companies. Second, a level of third-party review subject to attestation standards of those emissions data to increase their veracity and reliability. In short, companies will have to disclose a quantitative data set of greenhouse gas emissions subject to a gatekeeper's review. These gatekeepers must follow certainly widely accepted attestation standards, which includes a requirement that the gatekeepers be independent from the company. Moreover, companies will have to disclose if they dismissed or fired a gatekeeper over a disagreement related to greenhouse gas emissions disclosures, making it harder to hide deceptive or irregular practices. Third, a quantitative disclosure about certain expenditures associated with activities to mitigate or adapt to climate-related risks, transition plans, targets, and goals, so that investors can assess any progress or cash allocated for those purposes. Disclosure of these expenditures provides fundamentally important insight into how a company is managing risk and whether and how expenditures align with qualitative disclosures and stated plans, targets, and goals. Investors will have a new avenue to ensure that companies are doing what they say they're doing and consider the impacts of those activities. Fourth, a disclosure of material impacts on financial estimates and assumptions. This will enable investors to assess the reasonableness of the estimates and assumptions being made by companies. These requirements, among others laid out in the rule, move a haphazard potpourri of public company disclosures into the Commission's well-developed and standardized filing ecosystem. Commission filings come with a greater disclosure review process, heightened liabilities for material misstatements and omissions from both our enforcement program and private lawsuits, a level of reliability and year-over-year reporting that is conspicuously absent from climate risk information today, and being able to access those disclosures in one location. Investors made clear to my colleagues and me that these provisions are of key importance. Investors need insight into a company's business, its result, and its financial condition, including material risks it faces. To be crystal clear, though, this is not the rule I would have written. While these are important steps forward, they are a bare minimum. Ultimately, today's rule is better for investors than no rule at all, and that's why it has my vote. But while it has my vote, it does not have my unencumbered support. And although I am loath to leave for future commissions those obligations that I see as our responsibilities today, I'm afraid that is precisely what we are doing. Important disclosures remain absent from this final rule. On March 21st, 2022, we proposed a rule that, among other things, included 1, a more robust greenhouse gas emissions reporting requirement, and 2, transition-related expenditure disclosures in the financial statements. There is clear legal authority to update our disclosure regime to require reporting of these metrics, and robust public demand, as demonstrated by the public comments, showing that investors actively use those metrics for their investment and voting decisions. Further, reporting companies themselves voiced support for these disclosures. The final rule leaves these out. Today, we require certain companies to report scopes 1 and 2 greenhouse gas emissions directly produced by the company or that come from the energy the company purchases and uses, but only if the company determines that such emissions would be material to a reasonable investor. However, users of the disclosures expressed clear support for mandatory reporting for all public issuers with no materiality qualifier. Moreover, today's final rule excludes requirements to disclose Scope 3 greenhouse gas emissions, despite comments making it abundantly clear that they represent a key metric for investors in understanding climate risk, particularly transition risk. Today, we remove any Scope 3 requirement, even one with a safe harbor, that would have shielded issuers from liability for good faith estimates and reporting. Indeed, comments from investment advisors, pension funds, and the SEC's Investor Advisory Committee, among many others, highlight that Scope 3 remains an invaluable metric for investors. It is a comparable quantitative metric that allows investors to measure the risk across companies, sectors, and their portfolios. Overall, investor commenters described how they use greenhouse gas emissions data to inform their financial decisions to buy, sell, or hold securities. For example, one large pension fund expressed clear support for mandatory reporting of Scope 1, Scope 2, and Scope 3, subject to a materiality qualifier, and described how climate risk information permeates their investment analysis and decision-making across their $450 billion portfolio of state employee retirement funds. They noted that assessing the climate-related risks of their portfolio is conducted across active, passive, fundamental, quantitative, and factor-based strategies. And within each of these strategies, climate risk is assessed at the individual security level as well as the aggregated portfolio level. In other words, the use of these data mirror the use of other key risk metrics and are fundamentally important to investors. Also absent from the rule is expenditure reporting. The initial proposal contained requirements to provide line item disclosures in the financial statements related to and financial estimates and assumptions impacted by transition activities. These proposed provisions were met with overwhelming investor support, as they would provide better transparency and disclosure in the financial statement reporting. These disclosures would provide insight into publicly stated targets, goals, or plans that hundreds of U.S. public companies have made, a reference for investors to gauge whether qualitative discussions on climate risks are reflected in expenditures, estimates, and assumptions. And generally, they provide a degree of visibility into financial reporting for which investors have been advocating in this context and in others for years. Today's recommendation adopts an unnecessarily limited version of these disclosures. And why? One posited critique of the proposed rule was that the Commission lacks the authority to enact a rule requiring the disclosure by public issuers of climate risks. I disagree. The Commission has clear authority under the Securities Act and the Exchange Act to require disclosures that are in the public interest and for the protection of investors, as today's rule is. This well-established authority has been consistently relied upon and affirmed and reaffirmed across dozens of disclosure rulemakings over multiple decades. And this authority would have supported a more robust rule. The adopting release, as well as the comment file, details our numerous statutory authorities and the many disclosures we have promulgated based on those authorities. I will not rehash in great detail the work the staff's already done, but there are two noteworthy points. First, our public company disclosure regime is meant to be updated as markets innovate and investor demand changes. For example, in response to calls from investors, the Commission has updated disclosure requirements through rulemaking to include information about executive compensation, environmental protection law compliance and related litigation risk, legal proceedings, the background and qualifications of directors and how the board monitors and oversees risks, more detailed plans of operations for companies issuing securities for the first time, and a description of a registrant's human capital resources, which was enacted in 2020, among other disclosures. It is our obligation to respond to investors as the information needed to better assess the fundamental value of the securities they research, buy, sell, and hold evolves or changes. The Commission today is moving forward with a disclosure rule in response to well-demonstrated need for consistent, comparable, and reliable information. This rule responds to demands presented by investors and the market in a manner consistent with our practices in the past. Second, SEC rules have consistently required disclosure of risks, even when the metrics related to those risks are labeled by some as not strictly financial, such as the greenhouse gas emissions discussed above. Yet here too, we have heard argument that this agency does not have authority to require disclosure of information related to greenhouse gases because such data are not financial metrics. Once again, our actions are entirely consistent with existing precedent. Executive compensation, environmental protection law compliance, governance disclosure risk, and other disclosures mentioned above are prime examples of this. Cumulatively, these non-financial metrics provide investors with information that they can use to assess the overall state of an issuer. Likewise, disclosure of greenhouse gas emissions provides information that helps investors understand the current and potential financial risks a company faces. Given our clear authority, rolling back the proposal is a missed opportunity. It remains my great hope that a future commission will rise to the occasion and enact more fulsome disclosure requirements in furtherance of our mandate and investor demand. So looking ahead, the Commission should also think about issuing an order to recognize alternative regimes that would satisfy compliance with the rule we finalized today. Commenters noted that standard setters from other regulatory bodies, such as the International Sustainability Standards Board, or the ISSB, are implementing their own climate risk reporting regimes. An order recognizing such a regime would not only respond to investors, but also to the many corporate commenters who's favored such an approach. Although we leave it to the future, it would be an easy and meaningful step for the Commission to take in order to avoid a patchwork of reporting obligations and potentially conflicting demands. This idea was overwhelmingly popular in the comment file and mirrors other areas of the securities laws where there are comparable cross-border regimes. Additionally, once implemented, the Commission should also carefully review the effectiveness of this disclosure regime. Should we find that requiring materiality qualifiers in Scope 1 and Scope 2 greenhouse gas emissions reporting or other changes from the proposal results in insufficient information to adequately assess climate-related risk, we could consider guidance, 21A reports, FAQs, or other Commission action to ensure that investors have the tools necessary to make informed investment decisions and allocate their hard-earned money as they see fit. I've sat on this virtual dais before and cited Romeo and Juliet by William Shakespeare, and perhaps I need a new well from which to draw literary references. But at the risk of sounding repetitive, I think it bears relevance today. "What's in a name?" Juliet asks Romeo. "That which we call a rose by any other name would smell as sweet. So Romeo would, were he not Romeo called." Ultimately, the last names of Romeo and Juliet dictated their outcomes. The critiques I have heard about our rulemaking attempt to disguise our authority as something that it is not. It is said that we are not an environmental agency and that we should not be in the business of supporting green agendas or setting pollution standards. Those statements are true. But we are in the business of requiring public company disclosure about risk. We have done it myriad times without having our authority questioned. We require our public company registrants disclosures of risks related to interest rates, commodity prices, how a board is informed of risks, changes of ownership, merger transactions. The list goes on. That the term climate has become a buzzword should be of no moment to a clear-eyed Commission. It should not compel us to shy away from our duties and obligations to investors. Indeed, a risk by any other name of such import to public company investors would be worthy of Commission rulemaking. And so too is this. Our disclosures cannot remain stagnant. We must provide investors the information they need to understand the risks associated with their public company investments in today's world. A different outcome would harm the markets and investors. It would harm the safekeeping of hard-earned retirement funds, college funds, and savings of individual people and their families. Dollars that represent a lifetime of savings, financial stability, quality of life, and comfort. We owe it to investors to ensure that they adequately assess financial risks, that they can adequately assess financial risk. Today, we take a step in that direction. And while important, this rule could have been more. Thank you to all the commenters who took the time to give us your thoughts, your data, and views. And thank you again to the expert staff at the Commission, including those in the Division of Corporation Finance, the Office of the Chief Accountant, the Office of the General Counsel, the Division of Economic and Risk Analysis, IT, Facilities, and all of those that have been mentioned before who worked on this rule. I'm going to support. Thanks.
Thank you, Commissioner Crenshaw. Thank you for all your collaboration and your hard work on this, and also that reference to Shakespeare. Couldn't agree more that a risk is still a risk, and we have the legal authorities to help disclose those risks for investors to make their investment decisions. Commissioner Ueda.
Well, thank you, Chair Gensler, and thank you, Eric, Elliot, Paul, Aaron, and Jessica for your presentations. Today, much emphasis will be placed on how this rule has been dialed back from the proposal. Its focus on providing material information to investors, and that the Commission is not a climate regulator. To that, I emphasize the advice that I give to would-be investors. Don't rely on the marketing materials, but read the prospectus instead. By the time you finish reading all 886 pages of today's release, which is sitting on my back corner on my credenza, double-sided, I might add, you will conclude that this rule is climate regulation promulgated under the Commission's seal. Today's rule is the culmination of efforts by various interests to hijack and use the federal securities laws for their climate-related goals. In doing so, they have created a roadmap for others to abuse the Commission's disclosure regime to achieve their own political and social goals. First, they purchase shares in public companies under the guise of becoming investors, but not with the primary intention of seeking financial return. Rather, they use their holdings as a means to force companies to disclose information related to political and social issues important to them, but that may not be relevant to the company's businesses or shareholders generally. After some companies capitulate to their demands, they ask the Commission to adopt rules requiring disclosure from all companies, citing such investor demand for the information and the need to have consistent and comparable disclosure. A politically oriented Commission might pursue such a rulemaking. If it does, then the result is using disclosure not as a tool to aid investors, but to bypass Congress to achieve political and social change without the corresponding accountability to the electorate. The Commission is a securities regulator without statutory authority or expertise to address political and social issues. In adopting new disclosure rules, the Commission should understand the informational needs of the reasonable investor. That is precisely what the Supreme Court called for in TSC Industries versus Northway, when it stated that, quote, the question of materiality, it is universally agreed, is an objective one, involving the significance of an omitted or misrepresented fact to a reasonable investor, unquote. The court further noted that disclosure policy embodied in SEC regulation is, quote, not without limit, unquote. Thus, before requiring disclosure, the Commission should assess whether the benefits of the information to the reasonable investor outweigh the costs of producing the disclosure. Unfortunately, this analysis did not occur for today's rulemaking. Instead, the Commission has ventured outside of its lane and set a precedent for using its disclosure regime as a means for driving social change. If left unchecked, we may see further misuse of the Commission's rules for political and social issues and erosion of this agency's reputation as an independent financial regulator. The Commission asserts that the federal securities laws allow it to require information, quote, necessary or appropriate in the public interest or for the protection of investors, unquote, and explains how we have relied on these provisions for over the past 90 years to adopt various disclosure rules. But the Supreme Court has made clear that a colorable textual basis may be insufficient to support assertions of regulatory authority, especially if Congress was unlikely to delegate a policy decision of such economic and political magnitude to the administrative agency. In explaining the major questions doctrine, the court stated that extraordinary grants of regulatory authority are rarely accomplished through modest words, vague terms, or subtle devices. Today's rulemaking is an extraordinary exercise of regulatory authority by the Commission that involves an economically and politically significant policy decision. The Commission adopts an entirely new subpart of Regulation SK and an entirely new article of Regulation SX for one topic, climate change, applicable to all public companies. In so doing, the rulemaking elevates climate above nearly all other issues facing public companies. In no other context is a company required to provide an explanation of expenses that exceed 1% of income before taxes and analyze the significant contributing factors to the expense. For no other risk does the Commission require prescriptive, forward-looking disclosure of the risk's impact on the company's strategy, business model, outlook, financial planning, and capital allocation. Today's rule also requires disclosure of climate-related targets and goals, even though the Commission has no similar requirement for a company's targets and goals related to other, more important matters affecting the company, such as financial performance, product development, customer acquisition, or market expansion. Finally, the requirement to disclose greenhouse gas emissions and obtain an attestation report on such a disclosure is in a class of its own, without comparison in the Commission's disclosure regime. The Commission does not articulate any limiting principle for its claimed authority, and why today's rule is within that limiting principle. Perhaps the Commission does not believe that there are limitations. The Supreme Court has stated that in extraordinary cases, which I believe includes today's rule, an agency must cite to something more than a merely plausible textual basis for its action. The agency must instead point to clear congressional authorization for the power it claims. And the Commission has not done so for this rulemaking. Even without the major questions doctrine and concerns about statutory authority, the Commission conducted a flawed process by not reproposing the rule, raising questions of whether appropriate notice was provided under the Administrative Procedure Act. The Commission proposed this rulemaking nearly 2 years ago and received thousands and thousands, and I guess 24,000 is the latest number to date. And many commenters focused on the controversial part, to require companies to disclose their Scope 3 emissions. Given the proposal's expansive nature and its hundreds of requests for feedback, most commenters did not focus on or address every single issue or alternative raised. By removing the requirement to disclose Scope 3 emissions and making numerous other substantive changes, the final rule differs significantly from the proposal. One only needs to run a comparison of the proposed rule text and the final rule text to visualize page after page of extensive red ink reflecting strike-throughs and additions. I worried that my color toner cartridge was going to run out. The Commission has essentially admitted that the proposal did not get it right. Accordingly, the Commission should have reproposed this rule with an updated economic analysis and solicited additional public feedback. Doing so would have provided the public with an opportunity to focus on the aspects of the proposal that they did not initially consider and submit comments on the revised requirements. At a minimum, a reproposal could have resulted in a better estimate of the costs and benefits associated with this rulemaking. As the release notes, many commenters provided aggregate cost estimates that did not include certain elements required by the final rules, or included other elements that are not required in the final rules, and it was difficult to use these cost benefits to quantify the direct costs of the final rules. Now, the practical effect of today's rule is that companies' boards and management will need to spend more time and resources to think about, assess, and discuss climate change, even if no disclosure is ultimately made. Audit committees will be required to determine what it means to have had a severe weather event and other natural conditions. Lawyers and accountants will need to become well versed in hurricane categories and the enhanced Fujita scale. But there's an opportunity cost to all of this. By forcing companies to spend more time and resources on climate discussion, the Commission creates the risk that companies may ignore or not pay sufficient attention to other matters that could have greater and more immediate impacts. After the rule goes into effect, companies will have a duty to provide prescriptive climate-related disclosures, knowing that any non-disclosure, including assessments of materiality, will be judged in hindsight. To avoid potential liability, companies may voluntarily disclose climate-related information, despite concluding that the information is immaterial. Even when a company does not ultimately make any disclosure, it will have to spend considerable resources to gather and assess climate-related information, including potentially measuring its greenhouse gas emissions, in order to have effective disclosure controls and procedures, and, where applicable, internal controls over financial reporting. The takeaway is that climate will be nearly everything, everywhere, all at once for public companies. The primary financial beneficiaries of today's rulemakings will be the ESG consultants, auditors, attestation providers, and attorneys who will advise on compliance with these new provisions. Keep in mind that not one dime of the money spent on compliance will be used for actual reduction of greenhouse gas emissions, and that the shareholders will be footing the bill. Today's rule will eventually be felt by all companies, all public companies, that is. While the Commission could have exempted smaller reporting companies and emerging growth companies from aspects of today's rule, it has limited the relief only to disclosure of greenhouse gas emissions. Emerging growth companies did not receive an on-ramp for the disclosure requirements, which was the impetus for more companies to go public as part of the Jobs Act. Accordingly, after the compliance date for EGCs begins, they will need to provide climate-related disclosures on day one. Also, do not be fooled into thinking that limiting greenhouse gas emissions disclosure to large accelerated filers provides meaningful relief, because a company with a float as low as 250 million may still be required to report its greenhouse gas emissions. Finally, the Commission continues to diverge from its historic practice of largely deferring to the disclosures made by foreign private issuers pursuant to their home country reporting requirements. For climate-related disclosures, many foreign jurisdictions have adopted or announced plans to adopt their own disclosure requirements. The Commission could have eased the reporting burdens of foreign private issuers and made the U.S. capital markets more attractive to them by allowing these foreign companies to report climate-related information pursuant to their home country requirements. Such an approach may also encourage foreign regulators to allow mutual recognition of the Commission's rules with respect to U.S. companies with foreign operations. Unfortunately, the Commission's decision today may subject U.S. companies to multiple regulations on climate disclosure and make the U.S. capital markets less attractive to foreign companies. Because of the concerns I have with today's rule, I'm unable to support it. There are many important political and social issues facing the country, but the place to resolve these concerns is the halls of Congress, not the halls of the Commission. I thank the staff of the Division of Corporation Finance, the Office of the Chief Accountant, the Division of Investment Management, the Office of General Counsel for their work. In addition, I recognize the names from numerous other offices and divisions who are read off. So Director Green read off. So thank you for all of your work on this. I know you've been working on this rulemaking for more than 2 years and probably even longer than that. And during this time, you've met you've read thousands of comment letters, you've met with the public, and you've worked through different iterations of the rule. While I disagree with some of the procedural and policy aspects of today's rulemaking, the staff's effort to complete this rulemaking should be recognized. And I would especially like to thank Luna Bloom and Valiant Afshar from CorpFin, and Shaz Niazi, Aaron Nelson, and Megan Van Orden from OCA for their spending extensive time with me and my staff about this rule. So I just have a couple of questions. First, Director Walker, did I understand your response correctly to Commissioner Peirce that you would be consider doing a retroactive review of the costs and benefits of this once it's fully implemented after a few years have gone by?
We would consider it, yes.
Okay. Well, I'll hold you to it. I was in the room when Commissioner Atkins asked for some assessments of 404B back in 2008 from OCA, and then Commissioner Pivar, I was also in a meeting with him when he asked OCA and DERA for a follow-up after that further changes were made on ICFR. After 16 years, I'm still waiting for that assessment of 404B.
In this case, you're holding me to considering it, and I will consider it.
All right. Well, OCA, hopefully one day you'll get me something on 404B, and hopefully you don't disavow the representations of some of your predecessors. So physical risks. This is something that was brought up in the back and forth with Commissioner Peirce about the Reg SX piece, about other natural conditions. And I think, Commissioner, if I understand, the concern giving rise to this, Paul, is it's the physical risks that results from climate and other natural conditions. Is that correct? Or say weather events and other natural conditions.
Yeah, not entirely. It's, as I mentioned earlier, in determining whether costs need to be disclosed, it is not part of the process to assess whether the severe weather event or other natural condition was a consequence of climate change or a climate-related risk. It is whether there was a severe weather event or other natural condition that gave rise to either a change in the company's financial position or in results of operations that would require disclosure triggered off of the disclosure metrics.
Okay, so it's whether or not it has to do with climate, it's irrelevant. It's just whether or not it was a weather event or other natural conditions that gave rise to the change. Is that right?
Correct. And the rule provides for companies to adopt accounting policies that would allow them to make determinations as to what are severe weather event or other natural conditions that would be specific to their own particular facts, circumstances, and operations.
Okay, and Commissioner Peirce raised the issue of, well, what about a pandemic? But let me give you a different scenario. If we have another attack on our country like we did on 9/11, where terrorists inflicted significant physical damage in addition to human damage, that would not be something that would be considered a severe weather event or natural condition, even if it does generate significant physical effects. Is that correct?
I think that would be my initial reaction to that. That does not seem to be a natural condition or a severe weather event, Commissioner.
Right. I mean, that's how I read it too. And I think, I think that's part of, is this really about physical risk, or is this about trying to trace it to particular types? And, I think, we would have effects on the on the balance sheet potential, assuming it hit the triggers either way. But we are distinguishing between certain causes and not. Anyway, thank you. I don't have any further questions.
Thank you, Commissioner Ueda. Commissioner Zarka.
Thank you, Chair Gensler, and thanks to the staff for their extensive work on this very important rule and for their presentations today. Over the last 9 decades, the Commission, pursuant to authority granted by Congress, has amended its disclosure requirements on dozens of occasions. Commissions from both political parties have modernized existing rules or adopted new ones to adapt to changing market conditions, and to meet investor demand for improved disclosure of material information. In the process, the Commission has done what it does best: protect investors by empowering them to make informed investment and voting decisions. The climate-related disclosures we're advancing today are no different from many of the Commission's existing disclosure requirements, including those related to material litigation proceedings, risk factors, management's discussion and analysis of its financial condition and results of operations, mining resources and reserves, market risks for derivatives and other market-sensitive instruments, human capital resources, cyber governance and incident disclosures, and many others. Our securities laws are dynamic and adaptable. Our capital markets, the most resilient in the world, have benefited from the Commission's efforts to respond to investor needs and to market change. Today's reforms respond to investor demand for standardized and comparable information on climate-related risks and impacts. Investors view this information as relevant to a company's bottom line and as material to their investment and voting decisions. It can also assist with investors' analysis as to whether hedging or diversifying of their portfolio is warranted. The connection between climate-related risks and a company's fundamental value is well established, as highlighted by studies cited in the Commission's release. These risks play out through differences in revenues, operating income and expenses, cash flows, capital structures, asset prices, debt performance, and investment policies. Investor demand for climate risk disclosures has already had an impact on the market. For example, in the past few years, we've seen roughly 60% of Russell 3000 companies and 90% of Russell 1000 companies provide some form of climate-related information. And nearly 60% of Russell 1000 companies disclose scopes 1 and 2 greenhouse gas emissions. But under the status quo, investors would continue to face a patchwork of disclosures with a limited ability to conduct apples-to-apples comparisons. In the extensive comment process that preceded the proposal and the adoption of this final rule, commenters expressed concerns with a wide variability of voluntary climate-related disclosures and with a lack of reliable, consistent, and comparable information. By requiring registrants to provide standardized climate risk-related disclosures in Commission filings, market participants will benefit from being able to more efficiently analyze information that will be integrated with other important disclosures, such as a full description of the company, other disclosed risks, and the company's financial statements. The final rule will also provide investors with more liability protections than they receive today. In contrast to voluntary disclosures, the Commission will treat climate risk information in registrants' annual reports and registration statements as filed. This means that registrants can be liable under Section 18 of the Exchange Act or Section 11 of the Securities Act for any materially false or misleading statements. Such treatment will prevent greenwashing and place climate risk disclosures on the same footing as other information that registrants disclose under Regulations SX and SK. As is customary in the rulemaking process and consistent with the law, the Commission considered a wide range of commenters' feedback in its deliberations. Commission staff undertook a thorough analysis of this feedback and crafted a final rule that appropriately balances all of the input with the rule's policy goals. Some commenters argued that the Commission's proposed rule is unnecessary because climate risks are already subject to current disclosure rules if registrants deem those risks to be material. The Commission's 2010 guidance indeed emphasized that Regulations SK and SX may require disclosures related to climate-related risks, including in the description of business, legal proceedings, risk factors, and MD&A. But many commenters indicated that the 2010 guidance is insufficient for the current state of the market. These commenters advocated for standardized disclosures that facilitate comparability across registrants. That is what today's final rule attempts to do. Several changes to the rule between proposal and adoption also demonstrate the Commission's careful analysis of stakeholder input. mindful of concerns expressed around data collection, as well as possible indirect burdens on outside entities outside of the Commission's purview, the final rule does not require disclosure of Scope 3 emissions. Large accelerated and accelerated filers, however, are required to disclose Scopes 1 and 2 emissions, if material. The final rule requires attestation for these disclosures at the limited assurance level, and after a phase-in period, at a higher standard of reasonable assurance for large accelerated filers. Attestation must be provided by an expert in GHG emissions that is independent of the registrant and subject to the anti-fraud provisions of our securities laws. As a result, investors will have greater confidence about the accuracy and reliability of these disclosures than they do under the current voluntary framework. Smaller reporting companies and emerging growth companies will not be required to disclose Scopes 1 and 2 GHG emissions and will have a longer compliance phase-in period for other required disclosures. With respect to financial statement disclosures, the final rule streamlines the requirements to focus on discrete costs and expenditures incurred from severe weather events and natural conditions, which are already captured in registrants' financial statements. At the same time, the final rule requires material expenditures to be disclosed in Reg SK if incurred as a direct result of a registrant's mitigation or adaptation activities. Even though some registrants have voluntarily chosen to adopt a transition plan or climate-related targets and goals, or to conduct scenario analysis or come up with an internal carbon price, the Commission is not and does not intend to be a climate or merit regulator. However, for companies that take such actions to manage a material risk or impact, investors should have access to meaningful information to evaluate whether greenwashing is occurring. That said, to ensure such requirements are not unduly burdensome, the final rule provides a safe harbor for such forward-looking statements. Overall, the final rule is a product of the Commission's standard exercise of its basic authority to require full and fair disclosure by public companies to investors. It embodies a time-tested approach based on traditional notions of materiality familiar to the Commission's registrants and to market participants. The Commission's actions reflect investors' views that climate risks can be material to their investment and voting decisions, and that these risks can have a material impact on a company's bottom line. In short, the Commission is doing what it was designed to do: protect investors and foster transparent capital markets by improving the reliability, consistency, and comparability of material climate risk disclosures for investors. Chair Gensler and Commissioner Crenshaw, thank you for engaging so constructively with me in finalizing this rule. Commissioners Pearson and Ueda, you may end up having a different view than my own, but I respect your perspectives and appreciate your contributions to our deliberations. With the broad interest this rulemaking has received, inevitably, some will view it as having gone too far, while others will see it as not having gone far enough. An old familiar saying comes to mind: we must not let the perfect be the enemy of the good. In my judgment, this final rule, while not perfect, strikes the appropriate balance and is sufficiently robust to warrant the Commission's approval. I am pleased to support it. Thank you.
Thank you, Commissioner Lizarga. Thank you, all of my fellow commissioners. And I know, as Commissioner Lizarga just said, we may not ultimately agree on this one, but I think I share his respect for those who may be in opposition. I want to really thank Commissioner Crenshaw and Commissioner Lizarga for all the collaboration and trying to sort through with this remarkable staff, what I'm told is now 24,000 comments, but just, I think this is a step forward. As Commissioner Crenshaw said, there'll be more work to be done in the future, but I think this is an important step forward for investors to get more comparable, consistent, and decision-useful information, and for issuers to understand the rules rather than just guidance that's been in the books for 14 years. With that, how do commissioners vote on the recommendation?
No.
Yes.
No.
Yes.
Yes, the ayes being 3-2, the matter passes. It will be sent to the Federal Register, but it will be posted on our website later today. With that, we're going to turn at 12:05. We'll probably turn cameras back on, but to the equity market structure rule 605. Thank you. Thank you so much, and thank my fellow commissioners. We're going to move to the second matter on today's agenda, with the commission considering whether to adopt final rules to enhance disclosure requirements around order execution quality. I'm pleased to support the adoption because it will improve transparency for execution quality and facilitate investors' ability to compare brokers, thereby enhancing competition in our markets. It's in essence, when you think through the equity markets, the stock markets. And every day, investors turn to broker-dealers in the markets, often through brokerage apps, to build a better financial future. But how do you know, however, the quality of a broker's execution of your order? You can turn to measures that compare the price you received with that which is called the national best bid or national best offer at a particular time. The information is measurable, but currently the brokers whose apps you're using are not required to disclose execution quality in that way. Back in the year 2000, 24 years ago, the commission actually adopted a rule called Rule 605, which requires monthly disclosures on execution quality for market participants known as market centers. But in that nearly quarter of a century since that rule was adopted, things have changed, of course, and our equity markets become transformed by ever-evolving technologies and business models. Therefore, we're considering updating those rules to provide investors with a picture of execution quality that could be improved. I'm pleased to support the modernized rule, and it's got a number of ways, but probably the lead way is that the final rules will require large broker-dealers, those that have more than 100,000 customers, to disclose execution quality to the public. So it won't be just what's called market centers, but actually the brokers that the vast amount of the public is using, rather than just the market centers, which, to translate for you, is wholesalers in the dark markets that make these disclosures. And these larger broker-dealers combined handle about 98% of customer accounts. I think by requiring the large broker-dealers, like the ones having with these apps, to disclose quality as well, investors will be better able to factor execution quality into their decisions. You'll be better able to compare brokers when you select them. I think that the disclosures will foster greater competition amongst brokers, creating additional incentives to improve execution quality. There are two other matters, though, that are shifting. We're also proposing to require more types of data to go into these execution quality reports. Just for example, institutional investors today often use percentage-based metrics, such as what's called effective over quoted spread. Now, what is that? I think everyday investors would benefit from access to this. This percentage metric will help investors make apples-to-apples comparisons. It's basically percentages within the so-called bid-ask spread. And the disclosures would also give some ranges of order sizes from small notional amounts to 200,000 or more, so you can get a sense of quality in different ranges in there. Thirdly, today's amendments will require market centers and the broker-dealers, adding the broker-dealers in, to produce summary reports on execution quality that everyday investors can read. I think that it's important to kind of understand the current reports, this from 2000, look like a series of dashes, numbers, and symbols. I kid you not, it's kind of like the opening credits in The Matrix. I'm sorry, Commissioner Crenshaw, I wasn't quoting Shakespeare, but Keanu Reeves in The Matrix. By by coincidence, the matrix was released back in 1999, just 1 year before we had done the original 605 rule. But in the years since, the studios have released not one, not two, but 3 sequels to the matrix. And I think 3 matrix sequels later, it's about time that we develop a sequel to the current 605 reporting rule, welcoming execution quality reports to the real world where everyday investors can actually use them. And I think the final rules will not only bring broker dealers in to do these reports, but increase transparency for investors and facilitate their ability to compare brokers. Again, thanking tremendous work by a lot of people, the Division of Trading and Markets, the Division of Economic and Risk Analysis, Enforcement, Examination, and Investment Management. So you can see 5 divisions working on it, the Office of General Counsel, of course, thanking our Office's Secretary and our technologists and others and all of our fellow commissioners and their staffs. The names will be posted on the website. I will now turn it over to Haisheng Zhu, our Director of Trading and Markets, to discuss the rulemaking. 2 of his staff, I think Lauren and Kathleen, are going to join, Lauren Yates and Kathleen Gross, and then Jessica Wachter will represent the Division of Economic Risk Analysis. But over to Haisheng.
Thank you, Chair. Good afternoon, Chair Gensler and Commissioners Peirce, Crenshaw, Ueda, and Lizarraga. Today, the Division of Trading and Markets recommends that the Commission adopt amendments to Rule 605 of Regulation AMS under the Exchange Act to update the disclosure of all the execution quality statistics in AMS stocks. Rule 605 was adopted in the year 2000 to facilitate the ability of the public to compare and evaluate execution quality among different market centers. Rule 605 requires market centers to make available standardized monthly reports of statistical information concerning covered orders in national market system stocks that they receive for execution. Market centers must provide a number of execution quality metrics, including effective spread, average amount of price improvement, the number of shares executed, the speed of execution, among others. In the 2 decades since the adoption, information disclosed under Rule 605 has provided significant insight into execution quality at the different market centers. However, as the Chair previewed, Rule 605 has not been substantively updated since its adoption in 2000. In the interim, equity market conditions and trading technology have changed significantly. In addition, the participation of individual investors in equity markets have increased. Accordingly, the Division of Trading Markets recommends amendments to Rule 605 to update and improve the disclosure of execution quality information by, number 1, expanding the scope of entities subject to Rule 605 by including broker-dealers. Number 2, modifying the information required. And then number 3, making the key execution quality metrics more accessible to investors by using a summary report as well. Let me say a few more words about each one. First, the division recommends expanding the scope of entities subject to the rule. The amendments requires broker-dealers with a large number of customer accounts to produce Rule 605 reports. This will increase the transparency of large broker-dealers' order execution quality and give investors the necessary information to compare and evaluate execution quality and order writing practices among market centers and the large broker-dealers. Also, the amendments to Rule 605 would specify that AMS stocks, alternative trading systems, or ATSs, must report separately from their broker-dealer operators, and that broker-dealers operating single-dealer platforms must prepare a separate report for activities specific to these platforms. In each instance, separate reporting under Rule 605 would bring more transparency to these systems and the segments of equity markets that are away from the exchanges. Second, the division recommends amendments to the scope of covered orders and information contained in the detailed report, including how orders are categorized by size and type, the timestamp conventions, and which execution quality statistics are included. The effective over quoted statistic that the chair just previewed is one of them. And third, The division recommends amendments to require that every market center for broker-dealer produce a summary execution quality report in addition to the detailed report. The summary report would enable market participants and other interested parties to have ready access to focused aggregated data that will allow them to compare some of the more significant aspects of the execution quality provided by specific market centers and large broker-dealers. The division believes that these amendments to Rule 605 will provide individual investors, institutional customers, and broker-dealers with information that they can use to choose market centers or broker-dealers that align with their investment and execution objectives. I want to thank the many commenters on this rulemaking. Your active engagement and feedback have improved the adopted release. I would also like to thank the Trade and Market Rulemaking team, led by Kathleen Gross and Lauren Yates in the Office of Market Supervision, for their extremely diligent and thoughtful work. And finally, my sincere thanks go to our colleagues across the SEC, including staff in the Division of Economic Risk Analysis, the Office of General Counsel, the Division of Investment Management, the Division of Enforcement, and the Division of Examinations, among others. Their input was invaluable in preparing today's adopted release. I will now turn this over to Lauren and then Kathleen, who will discuss the amendments in more detail. Thank you.
Thank you, Hashan, and good afternoon, Chair Gensler and Commissioners. The Division is recommending several rule changes today to update the disclosures required for order executions in NMS stocks under Rule 605 of Regulation NMS. I will now provide an overview of the amendments to the scope of reporting entities subject to Rule 605 and the requirement for reporting entities to produce summary reports in addition to the more detailed reports. As Hashan previously discussed, the Division recommends that the Commission adopt amendments to Rule 605 that would require broker-dealers that introduce or carry 100,000 or more customer accounts to produce Rule 605 reports. The recommended minimum reporting threshold of 100,000 customers would balance the benefits of having broker-dealers produce execution quality statistics with the costs of implementation and continued reporting. Expanding the scope of reporting entities to include broker-dealers with a large number of customers would provide enhanced transparency to investors, allowing them to compare and evaluate execution quality among different customer-facing larger broker-dealers and promoting competition among these broker-dealers. The amendments would also require broker-dealers that meet or exceed this threshold and are also market centers to produce separate reports pertaining to each function. This requirement would allow market participants and other interested parties to view a firm's execution quality from the perspective of how it operates in each of these separate roles. Further, the Division recommends amendments that would impose a separate reporting requirement for covered orders submitted to single dealer platforms. To address concerns raised by commenters, the Division is recommending a modified description in the rule text of what type of broker-dealer activity constitutes single dealer platform activity for purposes of the separate reporting obligation. These amendments would require any OTC market maker that provides a trading platform for only a single dealer to solely buy and sell securities against all other parties entering orders in that system to produce a separate report pertaining only to covered orders entered in such trading system. In addition, the amendments would specify that ATSs must prepare Rule 605 reports separately from their broker-dealer operators. In addition, the Division recommends amendments that would require market centers and larger broker-dealers to make available a summary report. The Division believes that the summary report is a useful means to provide individual investors and other market participants with an overview of execution quality data. The summary report would aid investors by providing information in a more easily digestible format than detailed reports. To address concerns raised by commenters, the amendments include changes to the summary report. These changes, including breaking out statistics into notional size categories and adding realized and quoted spreads, would provide more information about the type of order flow received by the reporting entity. Based on such information, users of the summary report would be able to identify reporting entities with more comparable order flow and have greater context to understand differences in execution quality statistics between market centers and broker-dealers with less comparable order flow. Now, Kathleen Gross will discuss how the amendments would change the information required to be reported under the rule.
Thank you, Lauren. Good afternoon, Chair Gensler and Commissioners. The recommended amendments would update both the scope of orders covered by the rule and the content of the monthly reports. As Heshan mentioned, Rule 605 has not been substantively updated in over 20 years. Given the myriad changes to the securities market since adoption of Rule 605, the amendments would help ensure the continued transparency and utility of the execution quality statistics required by the rule. For example, average stock prices have continued to increase over time, and odd lots and fractional shares continue to trade with increasing frequency. Because Rule 605 size categories exclude orders smaller than 100 shares, a significant proportion of market activity is excluded. Taking into consideration comments received, the division recommends amendments to the scope of the rule as follows. First, the amendments would expand the definition of covered order to include certain orders submitted outside of regular trading hours, certain orders submitted with stop prices, and certain non-exempt short sale orders. Second, the amendments would modify the categorization by order size such that each order size category would reflect a notional dollar value range, along with an indication that the category reflects orders for an odd lot, a round lot, or a fractional share. These categories would increase transparency regarding distribution of order sizes that a reporting entity handles, particularly for higher priced stocks, and will make these metrics more informative for apples-to-apples comparisons of execution quality across reporting entities. Further, the division believes that fractional, odd lot, and larger sized orders of 10,000 or more shares represent important order flow segments, and by incorporating these orders into the new order size categories, Rule 605 reports would contain information about these orders that was previously missing from Rule 605 reports. Third, the amendments would modify how orders are categorized by order type. The amendments would eliminate the order type categories pertaining to non-marketable limit orders that are just outside, at, and inside the quote. Instead, the amendments would include order type categories for non-marketable limit orders that become executable and non-marketable limit orders priced at or better than the midpoint that become executable. In addition, the amendments would add separate order type categories for several types of immediate or cancel orders and orders submitted with stop prices. The amendments would scope in non-marketable orders and orders submitted with stop prices if they become executable during regular trading hours and would require certain statistics to be reported from the time such orders become executable in order to capture more relevant execution quality for these order types. The division also recommends changes to the information contained in the reports required under Rule 605. First, the amendments would use timestamp conventions of a millisecond or finer for time-based execution quality statistics. The amendments also would require average time to execution statistics for all order types. The amendments would modify the time to execution buckets to provide information about the distribution of execution times for all order types at a more granular level. Second, the amendments would include other required statistics in the detailed report, including realized spread statistics at 5 time horizons, effective spread, and effective spread divided by quoted spread, percentage base spread statistics for average realized spread and average effective spread, cumulative notional value, average midpoint, and average quoted spread. Third, the amendments would include statistics for a size improvement metric that measures displayed size at the time of order receipt, and an additional size improvement metric that indicates the amount of size improvement in those instances in which an order could have received size improvement. Fourth, the amendments would include price improvement statistics relative to the best available displayed price in the market, whether that is the national best bid or offer, or the best odd lot order to buy or sell. Fifth, the amendments would include additional measures of execution quality for non-marketable limit orders and certain orders submitted with stop prices, including relative fill rate. Overall, the division believes that by requiring the uniform public disclosure of useful and accessible statistics, amended Rule 605 would better promote competition among market centers and broker-dealers on the basis of execution quality, and ultimately improve the efficiency of securities transactions. Now, I will turn it over to Jessica Wachter, Director of the Division of Economic and Risk Analysis, to discuss the economic impact of the rule changes. Thank you.
Thank you, Kathleen, and good afternoon, Chair Gensler and Commissioners. As you've heard, today the Commission is considering adopting updates to the public disclosure of execution quality under Rule 605. Current Rule 605 requires reporting of execution quality statistics, namely how well market centers, that is exchanges, market makers, and alternative trading systems, execute orders for listed stocks. These statistics include averages of metrics such as price improvement, which is the difference between the price and the bid of a sell order and an offer of a buy, and metrics such as the difference between the price and the midpoint, which is the middle of the bid and the offer. These statistics also include information about time it took for the order to be executed and how many shares were executed at all. These Rule 605 statistics are an important source of transparency to the public. However, up until now, an important piece has been missing, and that is execution quality at the level of the broker-dealer. Research shows that this quality differs between brokers, such that the market center level execution statistics do not tell the entire story. The amendments would mandate Rule 605 disclosure for broker-dealers with 100,000 or more customer accounts. It would improve competition among broker-dealers and be an important step forward in transparency in our financial markets. In addition, the amendments to Rule 605, as Kathleen described, would make a number of modifications to the reporting itself. Execution quality tends to vary by order size. It may be easier to trade a smaller order than a larger one, but what makes an order small or large? It may depend on the stock price. The amendments would create buckets based on notional values, not numbers of shares. In a world where prices can differ by several orders of magnitude, this will more meaningfully characterize orders. Also, time to execution looks very different from when it did when Rule 605 was adopted 20 years ago. The amendments to Rule 605 would update timestamp conventions from the second to 1,000th of a second. Rule 605 as amended would also include odd lots, which have increased in importance, fractional shares, and information about size improvement, namely the number of shares executed at or better than the NBBO over and above the quantity of displayed shares. These enhancements will make it easier to compare execution quality among market centers as well as among broker-dealers who are newly reporting under these amendments. These amendments will come with compliance costs, and these will be greatest for those reporting for the first time. In closing, I would like to thank my colleagues in the Division of Trading and Markets in the Office of the General Counsel, with whom we've worked closely during the development of these amendments. And once again, I thank you again for your attention.
Thank you, Kathleen, Lauren, Hashang, and Jessica. Over to Commissioner Peirce.
Thank you, Mr. Chair. Thank you, Jessica, Kathleen, Lauren, and Hashang for your presentations. On balance, the Rule 605 amendments we're voting on today are positive. Over the past quarter century, since Rule 605 first mandated the disclosure of certain order-related information, our markets have changed dramatically. Decimalization, the adoption and implementation of Reg NMS, the increased speed at which orders are communicated and transactions are executed. All of these have combined to refashion the market in ways very different from the market of Y2K. Rule 605 has not kept up with these changes. The Commission gave hints that it recognized that Rule 605 was out of date just a decade after it was adopted. In the 2010 Equity Market Structure Concept Release, the Commission asked whether Rule 605 was fit for purpose in a market that had changed significantly over the preceding decade. The concept release also identified issues such as the granularity of time categories that are finally being addressed in today's rule. The Commission also noted that these disclosure requirements were drafted primarily with the interests of individual investors in mind, but expressed uncertainty whether individual investors understand and pay attention to these statistics, whether market participants make decisions based on this data, and if so, whether those decisions are beneficial to individual investors. The Commission and market participants continued discussing ways to address these deficiencies over the following decade, first in comments on the concept release and later in meetings of our Equity Market Structure Advisory Committee and recommendations that committee issued in November 2016. The conversation continued at a 2018 Market Data Roundtable. For much of this period, trade associations also have repeatedly called for the Commission to improve the quality of these reports. Given this history, I'm happy to see the Commission taking action on these amendments today. Although I have some reservations, the staff has carefully considered the many comments we received in response to this rule and worked to make Rule 605 reports more useful to investors and those who serve them. I don't agree with every call made, but the final amendments are a necessary response to the evolution of the market. And if we move forward with the other market structure rules that were proposed in December 2022, which I'm not arguing we should, getting Rule 605 amended and implemented first makes sense. Now to my reservations. First, as the history I just related shows, the original Rule 605 quickly became outdated given rapid developments in how our markets worked in the first decade of this century. Any additional transparency produced by the changes the Commission is considering today may just as quickly become clouded by market developments. Solving this problem is not easy. The Commission is a large organization that often out of necessity and prudence moves slowly. A market solution is preferable, but so far that has not succeeded in providing consistent data regarding execution quality across a large number of firms. We should not be complacent about allowing a costly regulatory reporting regime to persist if it's not providing reliable and actionable information to investors. We shouldn't wait for the next 3 matrix movies to come out if we need to update the rule. Not only with respect to this rule, but also more broadly, the Commission must stay informed of possible gaps between market developments in our regulatory framework and address them expeditiously. To fail to do so is to neglect our responsibility as a regulator and to risk a loss of relevance to and trust from the investing public. As the number of firms subject to the reporting agreement increases and the reporting framework becomes more complex, as is happening today, this problem becomes only more acute. For example, for the first time, the final rule requires certain broker-dealers that are not market centers to produce Rule 605 reports and treats broker-dealers that internalize only fractional share orders as market centers. I'm not entirely convinced that the reports produced by these broker-dealers will be useful to retail investors or that their usefulness will be commensurate with the costs of producing them. If the evidence suggests that reports from these firms are not benefiting retail investors or are becoming less useful over time, we should acknowledge it and take necessary steps to tailor the scope of the rule in response. Second, the approach that economic analysis takes to analyzing the economic effects of overlapping compliance periods, in particular between this rule and the yet to be implemented market data infrastructure reforms, suggests a higher level of confidence in our prior economic analyses than may be warranted. The economic analysis acknowledges that certain elements of the market data infrastructure rules, particularly the new round lot definition in those rules, mean that the baseline against which the changes to Rule 605 are being assessed incorporates certain assumptions as to the costs and benefits of the market data infrastructure changes that will occur at some future date. The analysis concludes, however, that given that the new round lot definition affects only a limited number of stocks, the market data infrastructure rules are, quote, not expected to have significant effects on the costs and benefits of the amendments to Rule 605. Although not ideal, this conclusion in this specific context seems reasonable, but if taken more broadly, it may raise questions about the reliability of our economic analysis. The relevant changes in the market data infrastructure rule are fairly discrete, as are their interactions with Rule 605. Going forward, however, we need to consider carefully whether there is a point at which it's imprudent to engage in further rulemaking when doing so requires us to perform an economic analysis that depends on multiple layers of assumptions about the expected but empirically unverified costs and benefits of closely related rules that we already have adopted but haven't yet implemented. Although this is a difficult line to draw, at some point, market participants may reasonably raise doubts about the accuracy and usefulness of an economic analysis that incorporates expected but unverified costs and benefits of prior rules, whose expected costs and benefits themselves incorporate assumptions about the costs and benefits of yet to be implemented rules. The concern is heightened with a rule like Rule 605. This rule not only seems to affect the baseline of other proposed rules, but itself will produce the data that will help us understand whether those other rules, if adopted, will generate the hoped-for benefits. A regulator has a responsibility to confirm that rules it's promulgated produce the intended effects without imposing disproportionate burdens. If the Commission proceeds to adoption of related rules before this rule is implemented, and before we have a clearer picture of execution quality under our current rule set, I'll be looking closely at how the Commission intends to measure those effects, both in any adopting releases and retrospectively having changed the measuring stick midstream. I'd like to thank the staff and TM, DERA, and GC and others throughout the building who worked hard on a very technical set of changes to this rule and for engaging closely with market participants to address their concerns about ensuring that the amended rule generates data that will be useful to the investing public. I do have a few questions. One of the criticisms of Rule 605 has been that it's not terribly useful to retail investors. I understand the argument that Rule 605 reports generated by market centers are used by broker-dealers and others who route retail investor orders. Thus, there's an indirect benefit. The reports under the amended rule will be in some ways considerably more complex, and it seems unlikely that retail investors will pay much attention even to the summary reports. How are retail investors likely to benefit from Rule 605 reports generated by broker-dealers under this amended rule?
I'm happy to take that one. I think that we believe the amendments, which today would include the reporting requirement for larger broker-dealers and the summary report requirement, would make the reports required by the rule more useful and more accessible, which may mean that retail investors are more likely to access them. I guess it would be important to note, too, that we had individual investor commenters that expressed interest in receiving access to execution quality statistics for larger broker-dealers. I think, some may use the more detailed reports, and the summary reports will provide human-readable information that any investor, including investors, can assess without needing technical expertise or relying on an intermediary. Even if they don't engage with the reports themselves, these investors could still benefit from increased competition among broker-dealers and having access to more digestible information about broker-dealers that may be produced by analysts, consultants, the financial press, and others. So I think that retail investors would still benefit from this rule.
So I hear that. I mean, I think it would be worth going back and looking whether retail investors are actually looking at the reports themselves. That might influence what we decide to do later. What's the case for requiring broker-dealers who are captured by the rule as market centers only because they internalize fractional shares, share orders to produce Rule 605 reports? And how many such broker-dealers do you believe there are?
Thank you, Commissioner. I can take that question. Fractional shares orders have become increasingly popular with individual investors, and we believe that it's important to provide standardized execution quality metrics for this segment of order flow. Our data analysis found that executed orders with a fractional share component originated from almost 5.5 million unique accounts. Further, orders for less than a single share have represented a significant portion of fractional order executions. While fractional share orders continue to represent a small percentage of originating orders that eventually execute, they represent a significant percentage of order executions originating from individual accounts. We'll now turn it over to Jessica Wachter to address the number of brokers that we estimate will be affected by the inclusion of fractional share orders.
Thank you, Lauren. Commissioner Peirce, so we estimate that all but 5 of the market centers that engage in the trading of fractional shares would also qualify as larger broker-dealers that meet the customer account threshold. So while there are up to 20 market centers that do engage in the trading of fractional shares, all but 5 of them are already reporting. So to your question, it sounds like 5 would be brought in simply for this reason. However, we believe that 5 is actually an overestimate because of those 5, a number of them may meet the account threshold in certain years, or they may, for example, trade in odd lots, so they may be brought in for other reasons. So the answer is at most 5 is what we estimate.
Okay, I appreciate that answer. I think given that it's such a small number, I would have said we could leave that part of the rule out. Presumably, many of the broker-dealers newly captured by this rule will look to third-party vendors to help them get their systems in place. Do vendors already provide such services to broker-dealers that are market centers because they operate ATSs or because they internalize orders?
So yes, that's our understanding, that market centers do use third-party vendors.
Have we looked at how much they charge for those services? And if so, did we use those data in coming up with our cost estimates?
So we report a range, and it's the same range that was in the proposal for the use of a third-party vendor, and that range is $36,000 to $42,000. So that range there was exposed to public comment. That's actually not the cost estimates that we use. We use the cost of producing 605 in-house, which is higher. So in that sense, our cost estimates are conservative and that they're on the high side.
What are our total cost estimates for a new broker-dealer brought in?
So that's a good question, and I think we're gonna have to follow up, but it is certainly in the economic analysis. I just don't have it in front of my eyes right at this moment.
No, I appreciate that. I mean, I guess my concern is when I hear a number like 36,000 to 40,000 for third-party vendor, my guess is that that's actually an underestimate. I think it's given everything in a rule proposal, it can be difficult to get comment on those precise numbers. And I think we sometimes rest in the fact that, well, no one responded. And so they're probably, we just use the same numbers. But I am concerned that we're underestimating. And I do think that this will be a major implementation challenge for broker dealers who are newly being brought in to the rule. And so just wondered how we're thinking about that in setting the implementation timeline and what we plan to do to help broker dealers during the implementation.
And Commissioner Peirce, before I pass this over to Trading and Markets for the answer to that question, I will note that we did receive public comment specifically on our cost estimates, and we did revise them upwards in response to that public comment. And now to your implementation timeline question.
And I'm happy to take the implementation timeline question. So our proposed implementation the amendments implementation timeframe would be 18 months after the effective date of the rule. So 18 months plus 60 days after publication in the Federal Register. So at least 20 months for implementation, which we believe is adequate time. We think that the compliance date strikes an appropriate balance between affording broker-dealers, market centers, basically sufficient time to program their systems and implement the business processes necessary to comply with the new rules, and requiring that the execution quality statistics in their Rule 605 reports become available to investors and the public in a timely manner. And then in terms of what we're planning to do to assist during implementation, staff is available to provide interpretive guidance as needed. And I know that the commenters have been very engaged with this rule over the years, over the past 22 years. And I know they're not shy about reaching out. So I think that, we're happy to provide that guidance as needed.
And I think you should actively engage with people who are working on implementation. It may be helpful to talk with them just periodically, even if they don't reach out to you. I would appreciate active implementation. Commenters have expressed frustration with their inability to examine the CAT data that informed our analysis underlying the December 22 market structure proposals, including this one. Why is it appropriate for the Commission to engage in policymaking on the basis of data that's unavailable to market participants?
Commissioner Peirce, I can take this question. The Administrative Procedure Act does permit the Commission to use non-public data in a rulemaking so long as the release allows for a meaningful opportunity to comment. The CAT database, as the release explains, and contains highly sensitive and granular market information. So the proposal described the CAT data that was used, the methodology for the analysis, and the results of the analysis. So even though the sensitive raw data itself is not being disclosed, the release does meet the APA standards.
Yeah, I just find it difficult, especially for the market structure rules that were also part of this package, and really having people really test what we're putting out there on the same grounds that we're looking at it. But thanks for your answer. In the proposing release, the Commission also relied on analysis of Rule 605 and 606 reports from a select group of broker-dealers. Notwithstanding the fact that these reports are public, the release dismisses a request from some commenters that we provide them with the identity of the broker-dealers whose reports were used in this analysis, given that, as one commenter noted, not providing this information, quote, prevents replication and analysis of the Commission's use of such data. The response read to me as a bit cavalier. The release says the reports themselves are publicly available and interested parties can analyze them using their own selection of broker-dealers. To me, that makes it look as if we're hiding the ball. Why not just tell them? Are we trying to make it more difficult for the public to check our work?
Commissioner Peirce, thank you for the question. I'm happy to take this one. As Megan just said earlier, the APA does require us to make the analysis so that people could meaningfully comment. We believe that the analysis using 605 and 606 data do allow the market participants to comment on it. And although we do not have 24,000 comments, this rulemaking did receive more than 1,000 comment letters. And on this particular point about individual identities in 606 reports, I just want to point out that the sample used in the analysis actually use the number of accounts they have or the number of trading activity. That information is potentially commercially sensitive information. So we must strike a balance between preserving and protecting sensitive information and also providing the public with comments. So we believe that the information we did provide allow the public to comment on this proposal meaningfully.
Okay, thanks. I think what confused me is that we're saying the reports are already public, so that's what confused me. But again, thank you for your answers today and for your work on this rulemaking and your engagement with my office. I don't have any additional questions.
Thank you, Commissioner Peirce. Commissioner Crenshaw.
Thank you, and good afternoon. Before Rule 605 was adopted, there was little publicly available information that investors could use to compare and evaluate execution quality among different market centers. Retail investors were not in a position to make informed decisions based on important measures of execution quality, such as effective spreads and price movements. Instead, these investors were left to choose among broker-dealers that ostensibly offered the lowest commission and quote-unquote fast executions. However, there was no straightforward way for investors to compare execution quality across broker-dealers or market centers when evaluating these claims. As a result, neither market centers, such as exchanges and certain market makers, nor broker-dealers had a strong incentive to compete on their ability to obtain the best prices for investor orders. Rule 605 was designed to empower market forces to achieve a more competitive and efficient national market system for investors by increasing the visibility of order execution and routing practices. The idea is that the rules disclosure requirements provide investors with a clearer picture of overall routing practices of different broker-dealers, which then facilitates greater investor involvement and choice in order routing decisions, ultimately resulting in improved execution practices. Indeed, a study on the impact of Rule 605 concluded that, in fact, the rule was effective. Overall, the goal of improving execution quality through more transparent markets was achieved. Although the rule worked and 605 has provided significant insight into execution quality, the content of the required disclosures has not been substantively updated, as you've heard, since the year 2000, despite changes in the speed and nature of trading. As a result, Rule 605 reports have become less informative than they were when the rule was adopted. Today's amendments will increase the relevance and use of information contained in the rules reports by expanding the scope of reporting entities, modernizing the content of the reports, and broadening the report's accessibility. For the first time, the amendments would allow customers of large broker-dealers, as well as other market participants, to have access to direct information about the aggregate execution quality achieved by their broker-dealers. Just like the disclosure regime for public companies, our disclosure regime for this information should be updated as markets innovate and change. Customers can use this information to compare execution quality across broker-dealers and select broker-dealers offering better execution quality. This increase in market participants' ability to compare such information should increase the degree to which broker-dealers compete on the basis of execution quality when making their order routing decisions. For example, by adjusting their routing practices to increase the extent to which they route orders to the market centers, offering better execution quality, and limiting the extent to which they route orders for other potential reasons. The amendments will also enable investors to make better apples-to-apples comparisons across reporting entities with potentially different order flow by expanding and modernizing order size and order type categories. In addition, the amendments will improve market participants' ability to compare time to execution across reporting entities by increasing the relevance of time to execution information in 605 reports. This is expected to lead to improved execution times, benefiting investors that value fast executions by helping them to identify and route orders to reporting entities offering faster execution speeds. Finally, execution quality is also expected to increase as a result of the amendments requiring reporting entities to prepare human-readable summary reports, in addition to the more detailed machine-readable reports required under pre-existing Rule 605. The summary report will provide an abbreviated overview of the more detailed Rule 605 report for interested parties to assess and is expected to help independent analysts, consultants, broker-dealers, the financial press, and market centers in analyzing the disclosures and producing even more digestible information using data from the summary report. This is important so that the broader public, including those that may not read the summary report, can still benefit. I'd like to thank the staff of the Division of Trading and Markets, the Division of Economic and Risk Analysis, the Office of the General Counsel for all their hard work on today's release, and I am happy to support. Thank you.
Thank you, Commissioner Crenshaw. Commissioner Ueda.
Well, thank you, Chair Gensler, and I concur with you on the number of matrix sequels, unlike our little disagreement on whether or not how you count the Rocky sequels I think we had in the prior OCM. Today, I should say also thank you to Sean, Lauren, Kathleen, and Jessica for your presentation. Today, the Commission considers amending the disclosure requirements for order executions in national market stocks. These amendments to Rule 605 will expand the scope of reporting entities to include larger broker-dealers and modify the definition of a covered order. The Commission's work reflects a careful consideration of the constructive comments received. These updates can enhance competition among service providers by giving investors better information regarding order execution. NMS stocks are traded simultaneously at different venues, including securities exchanges, alternative trading systems, single dealer platforms, and market makers. The Rule 605 amendments under consideration today should enhance that multi-venue competition intended by Congress. When Rules 605 and 606 were first adopted in 2000, publicly available information to compare and evaluate execution quality among market centers was sparse. Rule 605 would require standardized monthly reports of statistical information concerning covered orders for NMS stocks regarding execution. The existing rules have provided an improved awareness about how broker-dealers responded to the trade-offs between price and other factors, such as speed or reliability, and establish a baseline level of disclosure in order to facilitate cross-market comparisons of execution quality. The intent was to promote competitive forces that could be then brought to bear on broker-dealers, both with respect to explicit trading costs associated with brokerage commissions and the implicit trading costs associated with execution quality. As Commissioners Cynthia Glassman and Paul Atkins observed during the adoption of Regulation NMS in 2005, the disclosure framework that, quote, required market centers to publish execution quality statistics had an effect where competition among market makers increased significantly, unquote. Furthermore, overall execution quality for retail customers improved as competition among executing broker-dealers on the basis of execution quality became a means of attracting order flow. 25 years ago, Commissioner Laura Unger oversaw a report recommending the Commission consider requiring market centers to disclose information on best execution factors. The report also recommended requiring broker-dealers to disclose information about execution quality available at different market centers, order handling practices, and receipt of inducements for order flow. Those recommendations remain valid today. However, the adoption release recognizes that the equity market conditions have changed due in part to many technological advancements that have altered the speed and nature of trading, including the increased participation of individual investors in the equity markets. Today's action amends Rule 605 to address these developments. These amendments were proposed along with 3 other rules impacting equity market structure, but with little regard as to their interaction with each other. The other proposals were the Order Competition Rule, Regulation Best Execution, and amendments to Regulation NMS on minimum pricing increments, access fees, and transparency of better priced orders. It makes logical sense to approve the Rule 605 amendments first, given the significant information on execution quality that the Commission will receive from the updated disclosure requirements. I would have significant concerns before moving forward with the Order Competition Rule and Regulation Best Execution without analysis of the new data. The Commission cannot properly assess the balance of benefits and costs for these 2 proposals without observing the baseline impact on execution quality and costs implied by the improved disclosure mandated by today's rule adoption. Perhaps if we were in a DeLorean equipped with a 1.21 gigawatt flux capacitor, we could travel to the future and observe the impacts on execution quality and costs attributable to the Commission's action taken today. But neither the Commission nor its staff have access to such a vehicle. But if we did, I would hope that the use of plutonium as a fuel would minimize our Scope 1 and Scope 2 emissions. In the absence of such technology, a prudent regulator should exercise patience so that the effects of these amendments can be properly analyzed before turning any further regulatory dials. The Commission's regulatory regime has historically best served investors by creating a competitive environment, including for the use of execution services. Today's rule adoption, updating order execution, and cost statistics stands firmly within that tradition and should benefit investors and their trading needs. So I thank the Division of Trade and Markets and the Division of Economic and Risk Analysis and the Office of General Counsel for all of their efforts on this rule. I have no questions.
Thank you, Commissioner Ueda. I think we had just a difference on the Creed, the 3 Creed films, but I think we agreed there were 6 Rockies. But Commissioner Lizarga.
Thank you, Chair Gensler, and thank you to the staff for their work on this rule and their presentations. Since the Commission's original adoption of Rule 605 nearly a quarter century ago, the size, structure, and trading speed of our markets have all changed significantly. Although the rule has worked well since then, the information on execution quality included in current Rule 605 reports is less useful in meeting the modern needs of market participants and investors. The current scope and content of Rule 605 reports have fallen behind technological and market developments, such as increased retail participation, trading of fractional shares, and off-exchange trading. Today's reforms will enhance the decision useful information included in the monthly Rule 605 reports on order execution, including improved statistical measures of execution quality. Final rules will promote greater transparency, increase the information available to market participants, and promote healthy competition among market centers and broker-dealers on execution quality. Summary reports provided for under the rule will allow investors of all sizes, independent analysts, the financial press, and all other market participants to review user-friendly information on execution quality. I'm pleased to support these long overdue reforms to this important disclosure framework. Thank you.
Thank you, Commissioner Lizarga. Thank you, all of my fellow commissioners. How do you vote on today's recommendation on updates to Rule 605?
Yes.
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 Yes, the ayes being unanimous, the matter passes and it will be sent to the Federal Register and posted on our website shortly. I want to thank everybody and again thank each of my fellow commissioners, I know one of these rules was unanimous and one was 3-2, but all of the input from each of your offices and you personally have been really constructive and helpful in moving forward. But with that, the meeting is adjourned.